the leadership is clearly still coming from the top.
Markets are showing historically high levels of concentration.
It's all about tech earnings. All eyes are on tech.
There's a lot of high expectations in big tech.
At the end of the day, what's going to matter for this equity market is the earnings growth.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on this August Wednesday. John's still cruising around the Norwegian fjords. Annmarie and I are holding down the fort. A huge week of S&P 500 earnings grinding on Uber, McDonald's, and Disney all on deck. As traders show little patience for any sign of uncertainty or weakness. U.S. economic data building on this, showing just a hint of stagflation. And President Trump ratcheting up tariff threats with his eye on India, pharmaceuticals, and the chip sector. Traders are rewarding companies for having certainty. But the policy backdrop, Annmarie, is getting just a bit more uncertain at the moment.
Absolutely. Whether it's you looking at earnings like AMD, as you mentioned, or the ISM services data yesterday, what you see is the policy uncertainty now baking into the earnings. AMD, they basically can't answer a question on when they're going to start to put chips back into China that they had to take out and not send anymore because of the basically export controls from Washington and the reversal of that policy, or ISM services, some of that tariff uncertainty, even bleeding into services sector, which should be immune to that. You could see the policy uncertainty taking shape. And what's so interesting, Lisa, is that this is just the uncertainty of the tariffs, not the actual high tariffs rates which we're going to get Thursday.
Well, this is the reason why I think the ISM services data spooked a lot of people. This idea that a lot of people have shrugged off the ramifications, saying artificial intelligence, the natural strength of the U.S. consumer, could power through anything that we get from tariffs or the uncertainty of the economic climate. The fact that services stagnated on the headline number and that the employment component fell and that the inflationary inputs really rose to some of the highest levels since 2022, raised another potential risk that traders are grappling with.
Right, and this is the Fed's conundrum, according to Kamran. In a nutshell, he says this is their problem. Essentially, when you look at what's happening with ISM services, this is stagflationary outcome. All of this is happening at a time when the president is also saying he is prepared to name a name to go to the Fed, whether that person is going to be a short-term name just to get through to what was supposed to be the end of Kugler's term, or someone they're actually thinking that could leave the Federal Reserve when Fed Chair Jay Powell's chairmanship ends.
Yeah, and there's also this question about how much more uncertainty is going to be baked in when it comes to future tariffs. We've heard about India. We've talked about that extensively yesterday, raising the specter of pharmaceutical tariffs coming on, albeit small at first and then building. But chip sector, really going after that area. How much do we really have a sense of what the contours of trade policy really look like under President Trump?
Well, we do know when it comes to reciprocal tariff rates, 10, 15% minimum for all of these countries. And some countries are still trying to, as Jamieson Greer, the USTR representative, said, Ambassador Greer, trying to manifest the last-minute deal. And I think we've seen that overnight with the Swiss president coming to Washington without an actual formal invite. But then it's the sectoral tariffs that could potentially bite. And they've been doing these 232 investigations. I'm actually surprised we haven't seen them just yet, probably because they're still trying to deal with the reciprocal tariffs. But this is going to be things like semiconductors, pharmaceutical space, and even other industries that this administration say is critical and more manufacturing needs to be done in the United States.
Yeah, right now you're seeing stocks trying to bounce back after 6 of 7 days in the red to close the day. And this really is notable after reaching record highs, not led by big tech. Why? AMD, we'll be getting to that in just 1 second. Led by the Russell 2000. This goes directly to Fed bets as well as some of the more underpriced sectors, up 0.4% in pre-market trading. Coming up this hour, Macro Risk Advisors CEO Dean Curnutt amid a slew of Wall Street warnings. Heidi Crebo-Rediker of the Council on Foreign Relations, with President Trump ramping up tariff threats on pharmaceuticals and chips, and frankly of HSBC with China market concerns weighing on AMD's earnings report. We begin this hour with our top story. AMD earnings overshadowed by uncertainty in its China market. You can see those shares lower by about 6% in pre-market trading. Joining us now, Bloomberg's Peter Elstrom. They beat expectations. They even beat some of the forecasts. What went so wrong here?
Yeah, Lisa, this is a very good example of what you were talking about before. The expectations are so high in the AI sector that you really need blowout numbers all across the board to be able to satisfy investors at this point. As you mentioned, revenue was up quite sharply. It was up more than 30% for the quarter. They beat expectations in the second quarter. They gave a forecast of $8.7 billion in the third quarter. It all sounded good, but Lisa Su, the CEO, said they don't know exactly when they're going to be able to sell this chip you were referring to earlier, the MI308, into the China market. This is a chip that they used to be able to sell. Now they need to be able to get licenses from Washington to be able to sell that chip. Lisa said that they don't have any licenses so far. They're not exactly sure when they're going to be able to get them, and they don't want to count any of that revenue in the third quarter or count on getting that revenue until they get those licenses. So it sounds like mostly upside for the company if they're able to get some licenses and then sell those chips. But that uncertainty is really weighing on investors' mentality now and on the share price.
Peter Elstrom, thank you so much. And it really is this incredible irony that everyone is looking for certainty as we look at more policy uncertainty ahead. Joining us now to continue the conversation, macro risk advisor CEO Dean Curnutt of Wall Street. Dean, I'm just curious, Wall Street analysts keep warning traders to look out for the tariff-induced slowdown. We keep talking about that. We saw what happened with AMD. Can you square the uncertainty that's baked into policy with the certainty that traders are looking for from companies?
Right. So if we go back a couple of months when we were amidst the tariff tantrum, as some people have called it, those bad early days of April where the VIX got to the 50s and you had a lot of unwelcome movements in asset prices. I think that was the shock of understanding that Trump's, the foray into tariffs was going to be more substantial than folks by any stretch thought it was going to be. A little bit of seasoning of that. Now we're at, kind of 18%. And so now the question is, okay, what next, right? What are the ultimate implications from a growth and inflation standpoint for tariffs? Meaning the market shock is over. But like monetary policy, I'd just suggest that tariffs we have to think about in terms of, as they say, long and variable lags. We really don't know. We don't know if they're going to hit now, are they going to hit later? Are the impacts more on the price and inflation side? Are they more on the growth side? Are they a little bit of both? You've been talking a little bit about stagflationary impulse. And then, of course, ultimately the dance between markets and the Fed. Powell was pretty resolute in saying he needs more time. The market's already gotten to that full cut post that bad data on Friday. And so I think it's going to be super interesting, I think, to listen to Jackson Hole, for example, to see, if he really starts to, tell the markets, hey, we're going to go in September and the extent to which that cycle gets underway.
Before we get to actually the policy or potentially a Fed response, I want to talk about market technicals since you're so good at looking at volatility and understanding hedging risk and opportunity. I'm noting that the VIX is pretty low. It's not showing the volatility in policy. But I am noting that the after earnings moves in a lot of names have been incredibly large. I'm looking yesterday, AMD down 6% on what? A slight disappointment on the forecast because it didn't beat enough. We saw a similar kind of move in some of the other big tech. Supermicro computers also down by a significant amount. What's the message in that?
Yeah, that's a super interesting trend. And that's something that's been occurring for the last, I would say, decade, which is clearly you've got this special day 4 times a year. It's called earnings. And the realized vol of a stock on earnings day is going to be 3 to 5 times that of a non-earnings day, except that premium is going up. So what you're noticing is happening. It's been happening for a while. What are the implications for that? I think, number one, it makes hedging harder when you've got a burst of movement on a specific day. Everything's positioned into that number. And as you're saying, the number didn't seem bad. However, it's very easy to disappoint when maybe crowding in of positioning gets to a certain level. And so, I think that's something we have to be very mindful of, which is just this crowding, especially in things like supercap tech. Of course, it's been, the juggernaut that leads the market higher. As you sort of step back and think about the market risk as a whole, there's so much riding on this CapEx AI story, embedded in supercap tech that, again, these are the things I think about from a risk management standpoint. And it does become hard when you get these big, one-off 10% type moves in earnings days.
But in a morning like today, would you want to be buying the dip of AMD?
I don't know enough about the stock. I would say for me, when I step back and I look at the market dynamics, and I just think about the economy, the level of uncertainty in markets, and then the behavior of asset prices, there are times when there is just a disconnect. And I'd say that you can make the case right now that there is a disconnect between the low level of realized volatility in markets, which has been extraordinarily low. The triple Q had a realized volatility of 8% over the last month until Friday. Of course, that popped it up a little bit. And so as Lisa says, the VIX is low. It is low nominally, but it's not that low relative to the movements. The movements are very small. It makes hedging complicated when there's this big spread between the implied volatility of the VIX and then the low levels of movement in the markets. And then just from an uncertainty standpoint, I just step back and I just try to think about the derailers. What are the things that can go wrong? Again, the tech AI spending is the juggernaut that's empowering this market higher, but the chaos of tariffs and just the start-stop, the on-again, off-again, the broadsides on the Fed, I think, are very damaging to the backdrop for markets. And of course, the firing of the BLS secretary, I don't think that was a very good thing to do either.
So how do you hedge in a Trump world?
Yeah, so I try to keep it as simple as possible. And I love acronyms, and I've gotten to know ChatGPT. I've been ChatGPTing acronyms. And so I've got an acronym for surveillance, so maybe I can come back to that. Believe it or not, surveillance is an acronym. But the GOAT portfolio for me is great opportunities and threats. Okay, stay long the S&P. It's the most unbelievable benchmark the world's ever seen. It's almost impossible to beat. I won't try. But I do like hedging. And I think owning some very simple, what they call put spreads on the S&P, it's a really simple insurance strategy. You buy an out-of-the-money put, you sell a further out-of-the-money put to reduce the cost a little bit, and it's going to get you some downside protection. It would have been a nice thing to have in your back pocket through April. And then I've got two, what I just call FOMO diversifiers, gold and Bitcoin. I'm not Michael Saylor. I don't believe in all the hype. I do believe that Bitcoin is an asset that's different, and it has this characteristic where it can rise fast, and so it can get more volatile on the way up. And then gold, is different than Bitcoin. They call it digital gold and gold, but gold is clearly long the idea that Fed independence is going to be compromised. If we look at the 2 days where that got heated, it was in April and then about 2 weeks ago, gold was up about 2% on both of those days. So I do think you need these asset diversifiers, or the S&P diversifiers as well, along with some basic hedges.
If you want more on this, the After Hours special, Speaking in Acronyms with ChatGPT, will be coming to a podcast provider near you. So what's the acronym?
Okay, are you ready?
I don't know if I am, but maybe go ahead.
Surveillance, systematic uncovering of risk through vigilant examination, information, liquidity, leverage, activity, news flow, cross currents, and economics.
Love it.
And that took 1 second to generate.
Absolutely riveting and memorable. Thank you so much, Dean Curnutt of Macro Risk Advisors. Thank you. I can't say I'm going to be able to repeat that, Annmarie. Can you repeat any of it?
No.
Systematic risk.
Economics.
That's exactly something like that. Dean, thank you for that. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Good morning, Lisa. Swiss President Karine Keller-Sutter will meet with Secretary of State Marco Rubio on her emergency trip to lower the U.S.'s 39% tariff on Switzerland. The meeting is scheduled for this morning in Washington, but the Secretary of State's department does not lead negotiations for bilateral deals. It remains unclear if she will get to meet with President Donald Trump. Meanwhile, AMD shares are falling in the pre-market, down 6% after its earnings mostly beat expectations, but uncertainty in its China business is weighing on investor sentiment. The chipmaker declined to predict AI processor sales in China, as it said its licenses are still under review. And sticking with chips, 2 Chinese nationals were arrested on charges that they sent tens of millions of dollars worth of advanced NVIDIA chips to China in violation of export controls. The defendants allegedly used a company based in California to export the tech without getting government licenses. They could face as much as 20 years in prison. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, ramping up Trump's tariff blitz.
Do you still plan to follow through on your threat to impose 100% tariffs on all countries that purchase Russian energy, including China?
Well, I never said a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time. But we'll see what happens.
Heidi Crebo-Rediker of the Council of Foreign Relations joining us next as we do watch Steve Witkoff over in Russia today. This is Bloomberg Surveillance. Good morning. Welcome back. Trying to bounce a little bit after yesterday, losing some steam. We have been losing some steam after reaching record highs with 6 of the past 7 trading days seeing losses at the close. Today, trying to break that trend, up about 0.25% on the S&P. A bit of dollar weakness. Euro rising to 116 versus the greenback. And you could see yields climbing just a touch more, up 2 basis points. Ahead of that 10-year auction later today at 1 p.m. Eastern, 4.23% on that 10-year yield, and you can look for that $42 billion auction at a auction site near you. Under surveillance this morning, ramping up Trump's tariff blitz.
Do you still plan to follow through on your threat to impose 100% tariffs on all countries that purchase Russian energy, including China?
Well, I never said a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time. But we'll see what happens. We're taking in trillions, not billions, trillions and trillions of dollars from other countries who, for years, took advantage of us. They took advantage of the United States like we were children, and that's not happening anymore.
Here's the latest. President Donald Trump touting the substantial revenue stream from his tariffs. The president also pledging to increase tariffs on countries buying energy from Russia and introduce levies on chips and pharmaceutical imports, quote, within the next week or so. Bloomberg's Tyler Kendall joins us now. Tyler, a lot of moving pieces. What's got your attention for the day ahead, in particular ahead of that 4:30 p.m. announcement?
Yeah. Hey, Lisa. Good morning. Well, it is clear that there is still ongoing uncertainty, but perhaps we got the most clarity yesterday on how those pharmaceutical tariffs are ultimately going to be structured, with President Trump saying that they will start at a lower rate and then get higher over time. He said after a year to a year and a half, they could reach 150%, with the end goal being 250%. And the idea here is that it's going to take time to reshore manufacturing and supply chains. And perhaps this would provide a little bit of a buffer, because we have to keep in mind, as we wait for these sector-specific tariffs, those Section 232 investigations that precede them look into the entire supply chain, which ultimately means that we could see levies on the finished pharmaceutical product, but it could also mean that there could be levies on the ingredients that go into them. So there are going to be some pretty broad-based impacts that we're bracing for. And as we wait for an announcement on those sector-specific tariffs, we're also waiting to see if we could see any sort of last-minute deals clinched for these countries ahead of Thursday's deadline for the new tariff rates to go into effect. Of course, that could mean Switzerland, which we know is trying to negotiate last minute, but also India, considering that you mentioned that President Trump is looking to impose those so-called secondary tariffs on those countries that import Russian energy supplies. But Lisa, at the end of the day, one thing is clear, that the U.S. tariff rate has trended significantly higher. The latest number from our analysts at Bloomberg Economics say that if tariffs go into effect tomorrow, as announced, the average U.S. tariff rate will reach 15.2%. That's up from 2.4% from before President Trump took office.
Bloomberg's Tyler Kendall, thank you so much, and welcome back to the show. Joining us now to continue the conversation, Heidi Crebo-Rediker of the Council on Foreign Relations. Heidi, I want to stay on the secondary tariff issue and this question of how much the United States is prioritizing some relationships over the other and trying to understand which conflicts get precedence. What is your understanding of this renewed push to get Russia to make some sort of deal?
So, I mean, we have not only the August 7th tariff deadline coming up, but we also have August 8th, where the deadline was set for Russia to really make some concessions and start on a path to a ceasefire. And in the meantime, you do have India as one of the largest buyers of Russian oil and petroleum products. So they are facing not only the tariffs from the reciprocal tariffs, but they also are facing this secondary tariff threat that Trump alluded to, and they are one of the largest buyers of Russian oil. And he mentioned in one of his Truth Socials that they are that they are responsible for not only buying the gas and oil, but they're also profiting from it. So the killing of Ukrainians happening, you actually see a change in the relationship and the approach to India. It's very surprising. We've worked for many, many years in the United States to actually bring India into the fold as a real anchor to counter China in the Indo-Pacific. And this is really flipping that on its head. And we're looking at Trump now putting the conflict in Russia and India's funding of it really above, ironically, the important Indo-Pacific challenge with the geostrategic conflict with China. So I think it's an interesting aspect of this.
Heidi, sanctions don't always work. They tend to just create new markets. If Trump really wants to make sure that Putin doesn't have the profits from commodities, notably oil and gas, to continue funding this war, what steps does he have to take, given the work you've done in prior administrations when it comes to economic statecraft?
So the sanctioning of I would take issue with the sanctioning of the shadow fleets. I think that has actually had some impact on Russia's ability to fund really in a vast market now of illicit oil that they're shipping around the world. And so if you have the sort of the 1-2 punch of actually the U.S. stepping up and continuing to sanction those shadow fleet carriers, the way that the UK and the EU have continued to do, then I think that actually does take a bite out of the profits that Russia reaps from selling these selling the commodities around the world and going after the buyers. So really, India is in the crosshairs. China should be as well. It's the other large buyer, but India does not have the leverage that China has in terms of its rare earth magnets, and it's like it really does have that trump card over the United States when it comes to really negotiating anything these days.
Well, will the impact just be muted if the administration goes after some of these barrels going to India, but not the commodities going to China?
So it will be. I mean, obviously, in a world where you're going to actually impose secondary tariffs as opposed to secondary sanctions, you will have. I have a spider right there. Sorry. Yeah, great. So I think it would ideally be the going after both China and Russia on secondary tariffs, secondary sanctions, however you want to actually couch them. And the EU has taken an interesting step and has actually started to go after China as with secondary sanctions. So we'll see if those work. Obviously, with imposing sanctions, it's really the implementation. And so if you are the United States and you want sanctions to work and to bite, it is doing it together with other countries as well as really implementing them. If you're going to impose them, then you have to implement them. And that is where I think we've had a disconnect.
Heidi Crebo-Rediker of the Council on Foreign Relations, thank you so much. And I know that spider really had a lot to say on secondary sanctions.
Well, maintaining composure, though, when you see a spider for some people could be a huge feat, especially at 6:25 in the morning.
Well, maintaining composure through a lot of volatility, I think, has been a theme. I am curious about what's going on with Switzerland. I know we talked a lot about India, but what's going on with Switzerland?
Well, they were not invited. The Swiss president was not invited by the White House, but they have managed to get this meeting with Secretary of State Marco Rubio. Potentially that is a first step in trying to, as Ambassador Greer said, manifest a deal in the final moments. Remember, a deal was on the table. This phone call between the Swiss president and Donald Trump did not go well.
Manifest a deal. It's sort of like manifest destiny. Coming up, we're going to be talking less about that, more about this. Frankly, of HSBC reacting to earnings from AMD, those losses just building through the morning. Plus, Danny Berger with your morning movers and a check of Disney ahead of earnings. Trying to start the morning on a green foot, looking at some gains after yesterday's losses. 6 of 7 trading sessions have ended in the red, just coming off some of the steam that had built up some of these new record highs on the heels of AI promise. Right now, you're not seeing that outperformance in the tech sector, largely driven by what we saw from AMD, but also from super microcomputing, as well as Snap coming out with some disappointing earnings. We can see right now the gains being led by the Russell 2000 up 0.4% in futures. 3 hours away from the cash open, here are your morning movers with Danny Berger. Danny.
Hey, Lisa, let me show you some of the moves of what you mentioned. AMD being one of the biggest drags, down 6.2%. An upbeat forecast when it came to things like AI, but an issue for them, one, they've run up a lot, some 44% so far this year. And part of that run up has been baking in the idea that they would be able to return sales to China, though Julie Su, the CEO, saying on the call that she couldn't predict when that would return, and the U.S. is still looking at their licenses, so disappointment there. For super microcomputer, the disappointment was a cut to their forecast. It really just shows how the AI servers and the pricing for these big centers has been under pressure, so those shares falling a whopping 16.33%. Meanwhile, Disney, we're going to get their earnings, should be coming in this hour. They usually report around 6:40 a.m. Shares, though, advancing ahead of that 3.6%. An announcement from them that they will be deepening the ties between ESPN and NFL Media, buying them out. NFL Media gets a 10% stake. They also announced a new streaming service just called ESPN. It will include Hulu. It will include Disney Plus. We also have the pricing on that. It starts at $30 a month and then goes to $36 a month. By far the most expensive, just for reference point. Netflix is $25 a month, Lisa.
Yeah, it's getting expensive, Danny. It's sort of this interesting bundling of costs that is getting to be more and more than cable. We're going to be speaking more about this with respect to Disney, what exactly they're doing with ESPN and NFL. And you asked a great question, which is this sort of the precursor to spinning it off? Or is this a solution to keep your hands in the revenue pot while still getting an infusion of cash?
Right, because we do know that they are struggling on the linear TV front, but potentially this would be a first step if you want to just take it separate. NFL, ESPN, seems like they can go their own way.
Well, Rich Greenfield will be joining us later to discuss. On our radar this morning, President Trump vowing to ramp up tariffs for countries buying Russian energy, saying levies on chips and pharmaceuticals will be announced soon. Meanwhile, the Swiss president arriving in Washington without meetings after being hit with 39% tariffs. You put it all together, there seems to be this sort of drumbeat to tomorrow when we have this deadline. Not necessarily so much clarity on where the emphasis is. What's got your attention in terms of what the priority is heading into tomorrow?
Well, what got my attention is that we actually have the Border Patrol updating their computers for the new tariff rates. So all that uncertainty actually comes into play with higher tariff rates at 12:01 a.m. Thursday. So less than 24 hours. And you have this deal with Swiss that I find interesting because they had a negotiated text, per my understanding. Ambassador Greer told us last week that was not accurate. It was overstated, and nothing is agreed until everything is agreed. But this phone call clearly didn't go well between President Trump and the Swiss president. So she decided to get on a plane, which actually a lot of Swiss executives wanted her to do. Like the Swatch CEO said, you should just get to Washington. She wasn't officially invited, but she did manage to get a meeting today with Marco Rubio. So I think the readout from that meeting will be very telling. Can they potentially get something done before midnight?
Did she bring a watch? That's what a lot of people want to know.
What kind of watch? Is it a Swatch?
Exactly.
Is it a Tech? Is it a Rolex?
Burning minds of curiosity want to know. AMD shares falling in early trading. Concerns over sales in China overshadowing what was otherwise a really strong earnings report. The chipmaker declining to predict sales of its AI processor in the country, with its CEO, Lisa Su, saying its license sales still under review. Those shares down 6.3%, even with updated forecasts that exceeded expectations.
Yeah, they're adding an extra $300 million in the third quarter than analysts were expecting, but still something has spooked the market. And it likely could be what's going on with China. She was asked constantly on this call about the MI308 chip. This chip that they were selling to China, in April, export controls came on. They no longer could sell, and they still at this moment are not selling into China. They had a write-down when it came to this chip. And analysts just want to know, when are you going to get back into the Chinese market? I think it shows just how much that policy uncertainty is hitting earnings, because they couldn't forecast even when they're going to get the licenses back. And this is all analysts really cared about on this call.
Really, it seems like analysts and traders want Teflon. And Teflon can be found in artificial intelligence. It can be found in the promise and hopes and dreams of exponential growth ahead with the transformation of our workforce as well as the way that we operate factories. OpenAI is that name. It is in early discussions to launch a major secondary stock sale that could value the artificial intelligence company at around $500 billion. Just move over the $1 trillion valuation companies. This one's on the way. Sources telling us here at Bloomberg that the deal would raise OpenAI's on-paper price tag by roughly 2/3, going from $300 billion in its current valuation to $500 billion. It just shows what a behemoth and how quickly this one really has risen.
But I wonder if they have ulterior motives. So basically, you have Meta going out there trying to Trojan horse when it comes to Apple, OpenAI, get the best talent and bring them to Meta. By doing this, can OpenAI incentivize staff to stay on board? Give them actually some equity and have the share sale? Could they actually say this is a way we can retain talent?
Yeah, basically, here's your $100 million payout as well. You get a $100 million payout. Turning back to AMD and maybe $100 million payouts, frankly, if HSBC has a buy rating on the stock and a price target of $200 from the current $163, noting a bullish AI tone and need for higher conviction to drive earnings upside. Frank joins us now for more. Frank, thank you so much for being with us. How frustrating is it to get the fundamental story right and the price action wrong?
Yeah, no, that's a good question. I think when you think about this, though, it was just really about the conviction that the management needed to give people. We had a really strong run up into results. So I think going into these results, people were looking not only for a good number, but something tangible for analysts to be able to raise their numbers significantly after these results. And I don't think we got that. So I think that was why the shares didn't react so well. And I think the other point was China as well. There was a lot of expectations built into that the MI308 would come back, but it also shows you the complexities of the China-U.S. relationship. So I think now people are going to have to take a step back and look at whether or not how quickly these licenses can come and how quickly these revenues can come. But again, I think the market is over-focusing a bit on it because if you look at the fundamentals, there's a lot of growth still in the hyperscalers. That's more than enough to go around to drive their growth.
So are investors just sort of looking for certainty where there is none? Are the outperformers right now just giving false promises of hope? Or are you saying that essentially there are some companies that are more fortified against some of these uncertainties and are getting rewarded for that, and these others are sort of in a wait-and-see mode from a stock performance standpoint?
Yeah, so I think, the China element certainly has become a big part of the narrative this year, not only for AMD, but also for NVIDIA. So I think that has complicated the AI story a bit. In a way, I think, that the expectations are probably a bit more bullish on that. But we also believe, though, that you don't quite need the China story for this to play out. I mean, we still see very strong demand. They highlight on the call that the MI355 is doing very well, better than expected, and the pricing outlook is better. So we do think that it can continue to work, but I think the narrative has been a little bit too narrowly focused on the China part, and we've come to a realization that it's not going to be as easy for China revenues to come back in as people previously expected.
If we could sit on China for a second, why is it so much harder for AMD than NVIDIA?
Well, we haven't seen the NVIDIA numbers yet. So I guess, over the next month, we'll see how much the NVIDIA comes back from China. I think AMD did disappoint in the fact that they haven't started their revenues. We do expect, I think NVIDIA had more inventory on hand that they could probably ship out. You also saw that AMD had a lot of work in progress inventory. So that has to be resumed. So that's going to take a bit longer versus what we saw potentially for NVIDIA, which had already built up, finished good inventory.
But NVIDIA has been, at least when it comes to the rhetoric, very bullish on getting back into China. Actually, we learned of the Trump administration's U-turn on these export controls because Jensen Huang was in Beijing and NVIDIA released a statement that they're going to put the H20s back in the Chinese market. So would you say they are months ahead of where AMD is?
I think they, like I said earlier, I think the way their product has been built out, they've already shipped out a lot more chips. So I think they are in that sense ahead. Whereas, AMD has admitted that they have a lot of these products are still in the building phase. So that's why it's going to take longer, as well as waiting for the licenses. So I think that's probably one of the reasons why you see, a stronger recovery for NVIDIA from the China part.
Frank, we hear a lot of noise about tariffs and ongoing discussions that are happening right now. The president of the United States has talked about semiconductor tariffs that could go on as soon as this week. How much is that already factored into a lot of the earnings? How much noise is there and how much signal?
Yeah, so I think, the semiconductor tariff is definitely something that has been on people's minds. I think for the most part, if you see a tariff that's less than 20%, I think the market will take that quite well. But it could be a lot higher than that. I think it's going to hit the actual chip makers like TSMC a lot harder. I think the companies that are leveraged to the hyperscaler growth, then can pass on some of these prices increases more effectively as the hyperscalers have a lot bigger capex budgets and continue to raise them. So I think it's going to hit the consumer part of this semiconductor pie a lot harder than it's going to be on the AI side.
Frank, what about some of these proposals to put tracking devices in certain high caliber chips, as well as some of the constraints without constraining the supply of chips? I'm really trying to wrap my head around what the administration is trying to do to keep the flow of commerce while clamping down on some of the more sensitive chips. Do you have a sense of how this is coming together, of what this proposal looks like?
I think it's still very difficult to have an idea of how it's going to end up. But remember, this also isn't entirely one-sided. We've had some chatter last week of China having some concerns about the NVIDIA chips as well, in terms of whether there's kind of a kill switch. So I think there's going to be a lot of back and forth when it comes to this. So I think for most people that look at the AI story, we should continue to look at outside China as an area of growth, right? I know the narrative continues to be on China, but if you look at, what's really doing well, basically, the AI companies, these chips are doing fine without the China market. I know people would like the China market, but if you take out the China market, these guys are still growing, and I think for the most part, still beating expectations.
Frank Lee of HSBC, thank you so much, as always, for your insights. Right now, we are getting some numbers from Disney. Annmarie, really interesting to see beats across the board. The earnings per share for the third quarter coming in at $1.61 versus the estimate of $1.46. You're looking at revenue that came in above expectations, or basically meeting expectations. A lot of positive, and yet what we're seeing right now is sort of okay, what have you done for me lately?
Right. Disney shares were actually much higher in pre-market based off that excitement yesterday when it came to the ESPN to buy the NFL media assets. What potentially is not spooking, but a little bit more of a concern, now it's only up 0.4%, is their third quarter sports revenue came in lighter than estimates were expecting. So it came in at $4.31 billion. Estimates was for $4.44 billion. What's interesting, Lisa, is that it's still a good report. It raised its full year profit forecast, but maybe just wasn't enough.
Yeah, and we're going to find out more. The call is in about an hour and 45 minutes. We'll be following this throughout the morning, as well as the other earnings reports that are due out any minute. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. President Donald Trump's special envoy, Steve Witkoff, has arrived in Moscow for high-stakes talks with Russia's President Vladimir Putin. The meeting comes just 2 days before the August 8th deadline that was set by President Trump for Russia to reach a truce with Ukraine or face potential sanctions. Meanwhile, here, President Trump has said he plans to make his decision on a replacement for outgoing Fed Governor Adriana Kugler this week. According to the president, his selection is down to 4 people, including former Fed Governor Kevin Warsh and NEC Director Kevin Hassett. And the Trump administration will end a government-wide program started by Elon Musk to summarize 5 workplace achievements from the last week. The Office of Personnel Management said it no longer plans to manage or utilize the process. Many agencies had already stopped requiring the weekly emails, but some were still sending it to the office. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I'm still working on mine. It seems like that whole Doge program has kind of been fallowed a little bit.
Dismantled a little bit, especially when the first buddy left. Yeah. And that was a lot of excitement we saw from individuals, especially outside Washington and on Wall Street.
Read my emails, talked, woke up early. Up next, IPOs make a comeback.
I think it's fair to say that the markets are open for IPOs. What you're seeing with the reception of the companies that have come to market is that pent-up demand in the public market.
Kamran Ansari of Kapital Ventures joining us next to talk about the state of play for companies looking to go public. This is Bloomberg. bit of gains this morning after yesterday's losses. There has been a bit of a cooling off in some of the activity that we've seen in equities as a number of traders assess weaker than expected economic data, as well as reports that just aren't able to meet expectations even when they do seem to beat expectations. Right now, S&P futures up about 0.2%, seeing a bit of dollar weakness, 116 on euro versus dollar. Yields climbing, creeping higher. 10-year yields 4.23%, ahead of a $42 billion auction of 10-year notes later today. Under surveillance this morning, IPOs making a comeback.
I think it's fair to say that the markets are open for IPOs. What you're seeing with the reception of the companies that have come to market is that pent-up demand in the public markets. Now that there is more certainty around the geopolitical landscape, more certainty around the market and the trajectory of the market. That's why you're seeing these companies finally come to market.
Here's the latest. A rising number of private companies going public, buoyed by strong debuts from tech companies like Figma as well as Circle. Kamran Ansari of Capital Ventures writing this. IPOs are starting to come back in the second half of 2025. Look for names that follow current trends. Kamran joins us now. Thank you so much for being with us. Names that follow current trends. Is that code for watch tech companies come to the public market?
And not just tech, but within tech, you're seeing crypto companies in particular with Circle and eToro coming out. And I think you're going to see potentially folks like Rakuten or Grayscale and some of these others follow suit, because that's been a trend that's really been developing as the Trump administration has come in. Has been more focus on kind of allowing crypto to kind of grow. But also, yes, broadly, more tech companies that have stayed private for years are now finally seeing the so-called IPO window open after kind of, I think 2-3 years of quiet time.
What does that mean? The IPO window opening, given the fact that the market has been very open, it's just that valuations haven't been what people have wanted them to be.
Exactly. And I think, private companies can suffer from what I call valuation nostalgia, where you're thinking, I used to be worth X and now I'm worth Y. So until you kind of have that moment where you realize, okay, we have to reset, and Klarna did that when they filed, Chime did that when they filed and came out. They have to figure out, okay, look, I may have been worth $25 billion before, like Chime was, but I came out at 10 to 12, and now I can grow from here. Because an IPO, it's like the old ad with bankruptcy. It's not an end, it's a new beginning. It's the start of a whole new life for you as a company to continue to grow from there. So then to get to that point, a lot of companies have to do a valuation reset.
What's changed recently? Because coming to 2025, everyone seemed very excited. They thought the policy backdrop in Washington was going to benefit IPOs hitting the market, but then it was crickets.
Well, one of the things that happened is we thought so, too. With the new administration coming in January, February, the tariffs all of a sudden put a freeze on the market. Because Klarna filed, they're about to come out, and then at the last minute, they pulled in and said, we're going to wait. And that was because of market volatility around February, March. So I think once you've had some of these trade deals happen and the tariff situation settled down, the market's gotten better overall, you're seeing companies think, okay, well, they've been ready to go. Like when I was at Pinterest, we had the documents sitting in this room, in the conference room. It wasn't like some mystery, like all our numbers are basically public at that point. So these companies are essentially ready. Many of them are, and they've been waiting for the right moment in terms of market receptivity. And I think we're kind of there now.
What other policy risks potentially could there be? Because Trump is still negotiating trade deals at this moment.
The lack of predictability is the big issue. So anything could happen, right? Tomorrow there could be another set of trade deals or tariffs announced that puts another freeze. And which is why these companies, the IPO window, as it were, is fragile, right? It's open, but it can close quickly. So I think when companies are ready, they want to get out, do the roadshow. And also, there are only certain times of the year when it makes sense to go public. You usually don't see a lot of listings, frankly, in July and August. So Figma coming out in July is a relatively unique phenomenon. So you see kind of companies coming out in kind of Q1 and in the spring, and then again, they'll come out kind of in the fall towards November, December. But I do think there's still risk, of course. Any kind of new economic policy, or if the interest rates continue to kind of stay stable or even increase, that would be a big issue for these companies.
That's where I wanted to hone in.
Yeah.
How much is this IPO cycle predicated on 2 rate cuts this year by the Fed?
I don't think it's necessarily predicated on that, but if that does not happen, or if that policy is reversed, or the market sees any inclination that there's not going to be a rate cut, or in a worst case scenario, rate increase might be on the horizon, that would put a bit of a freeze on it. But honestly, again, these companies I think have been ready to go. There are a number of names that I think we'll look at for the second half of 2025 that we can talk about, besides Grayscale and Kraken, that I think are going to be coming out.
Somebody who might be skeptical might say a lot of companies have been waiting for some sort of valuation that looks attractive, and suddenly they're getting attractive valuations. And if it's a seller's market, that means it's not exactly a buyer's market at a time when a number of Wall Street analysts have warned about bubbles, froth, especially in some of these areas that you mentioned. How can you determine whether they're just trying to time the peak, or whether this actually does represent a durable cycle that actually is coming from strength in the capital markets and not just, a frothy blow off top?
Yeah. Well, I think it's not just about the strength in the capital markets, but these companies, the numbers are strong. I mean, Figma's numbers are remarkable, right? It's a company with almost 90% gross margin, massive retention of their client base. And so with those kinds of numbers, it doesn't matter if the economy is good or bad or the market's good or bad. I mean, that company is durable, right? So these companies are not going public just because it's a moment in time and they have kind of, smoke and mirrors type numbers. These are durable businesses that I think are going to last. But the real moment for me is, seeing all this discussion the last week about, the stock popped, now it's back down. The moment that you really figure out what these companies are worth is 6 months in, because that's when the lockup comes off and all the early investors and employees and founders can sell their stock. And you really see, well, what is this thing worth? Until then, it's all going to be kind of a little bit of a theater.
So year end, we'll have a better picture of what this really is worth.
This time in January.
So you're focused a lot, and the market's focused a lot on all these tech companies coming to market. What other potential IPOs could we see outside technology?
Sure. Look, I mean, until the most recent cycle, one of the best companies that had come out was Kava, the retail food business. So I think Skims is one that's been reported to come out. StubHub, which is obviously the ticket site, is one. Panera Bread, I saw. Liquid Death, the water business. So there are lots of companies that I think are great businesses outside of tech that also you're going to see them trying to list.
Kamran Ansari of Capital Ventures, thank you so much. Really great to have you on the show. And I can't get over the fact that someone puts a skull on water and then sells it for $2 and people are like, yes, but that's kind of where we're at.
I think it's because it's in a can, too. I think people like the fact that it's a can, yeah.
All right, well, all I know is we're looking at some earnings this morning. We did get Disney earnings, and just parsing through all of it, they actually did increase their forecast for the year. Their forecast beat expectations, topping estimates, seeing full year earnings per share of $5.85 from the expectation of $5.77, not doing anything for those shares. People looking at a disappointment in the third quarter. And again, what have you done for me lately seems to be the theme for all of these stocks that are coming out and performing what seem to be pretty solid earnings.
Pretty solid earnings, but it just doesn't seem enough for some of these investors. Also, potentially what you see in Disney is just some profit taking, because shares were up higher based off the fact that they came out, they had this deal with ESPN and NFL's media rights, and maybe this morning some investors are thinking, I could take some profit.
Meanwhile, we're also getting Uber numbers, seeing gross bookings for the third quarter actually beating expectations, up to $49.75 billion versus the estimate of $47.6 billion. Those shares surging in the pre-market trading. Again, how the market responds gives you a sense of where we're coming from, let alone the expectations. Coming up next, we'll look through all of this and get some earnings from McDonald's, Stephen Auth of Federated Hermes, Michael Townsend of Charles Schwab, Anastasia Amoroso of Partners Group, and Joseph Briggs of Goldman Sachs. This is Bloomberg Surveillance.
Right now, the market is becoming more desensitized to tariffs.
The market has pretty much gone to sleep on the tariffs.
The markets would love to put the trade war behind them.
The continuing narrative throughout the fall is going to be trade policy uncertainty.
We're all holding our breath to wait and see how bad the trade disruptions will be.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. We're getting a slew of earnings this week. This morning, already getting reports from Uber, Disney, and just crossing McDonald's. You'll learn something from the numbers. You'll learn something else from the trading action and just how much there are very high expectations. Meanwhile, tariff threats abound with talks of India, talks of semiconductors, talks of pharmaceuticals, all coming to the fore with the 4:30 p.m. meeting with President Trump. Annmarie, I have to say, this morning, the response from traders really notable to a number of different earnings reports. What have you done for me lately seems to be the theme.
I mean, we see a lot of uncertainty that's being baked in. Earlier this week, Lori Calvasino put out a note talking about the angst returns, and she said how a lot of that is deserved, and a lot of this is coming out not just from the numbers, but the corporate commentary. And I really was fascinated by AMD last night. Consistently asked the CEO, when are you going to go back to selling in China, given we've seen the export control reversal by this administration? And they couldn't give the market a date. They couldn't give it details on when they were going to re-enter that market with this chip. At the same time, they had a great report, but it just wasn't enough.
So this to me is fascinating. It seems like traders want certainty amid an uncertain backdrop. People don't want to hear the word uncertainty or risk. They want to hear we are confident and we have a bulletproof business model. We saw this morning something similar from Disney actually coming out with a forecast that beat expectations, those shares lower. Uber coming out, those shares also lower in pre-market trading, even after they beat on the bookings and increased their forward look. All of these types of actions give you a sense of people getting concerned that maybe valuations have run too far, too fast.
Right, and they don't still have the policy certainty they're looking for. And it does feel like what you see in some of these market reactions is you see investors weighing the bad news more than the good news. So in all of these reports, there's some good news, there's some bad news. I'm just looking at Disney right now. They had some really good news, but still the market is honing in the fact that pay TV troubles. That is overshadowing Park streaming and the deal they came out with last night with NFL.
Yeah, the idea of a partnership between ESPN and NFL. We'll get into all of the deal specifics as well as the McDonald's earnings in just a moment. But this comes amid a slew of future threats, particularly in the semiconductor field, as well as, of course, pharmaceuticals in India, which is the secondary tariff issue. And I just wonder how much more we're going to get and how much is priced in. We were talking to Frank Lee of HSBC, and he said anything in the semiconductor space under 20% probably will be treated as a relief when it comes to the semiconductor stocks.
But potentially we might get more than that. And we do know that the president does like to anchor the conversation to the extreme. So you could see him come out with something much higher than 20%, but then maybe it will level out at something under that. Semiconductors, pharmaceuticals, these are still the sectoral tariffs, Lisa, we are still waiting on. And then there's two countries specifically today before midnight we're going to be focused on, and that's Switzerland and India.
Meanwhile, you are seeing a bit of a gain in futures this morning after yesterday's losses. And we've seen 6 of 7 days an inability for futures to close, or actually stocks to close higher on any given trading session. We see the S&P up about 0.25%. The Nasdaq underperforming here with futures up about 0.1%. Russell 2000 outperforming. What we are expecting today is also a 10-year auction, $42 billion of notes to understand exactly what people's confidence is there. Coming up, do not miss this. Stephen Auth of Federated Hermes remaining optimistic on the economy. Michael Townsend of Charles Schwab as President Trump ramps up his tariff threats. And Joseph Briggs of Goldman Sachs on potential labor market disruption from AI, one of the hot topics for policymakers and companies alike. We begin this hour with stocks rebounding just a touch as traders digest the latest batch of earnings. Stephen Auth of Federated Hermes writing this: we remain optimistic. This season has been exceptionally positive, with earnings running 8% year over year and upward revisions running higher than usual. Stephen joins us now. Stephen, wonderful to see you. Thank you so much for coming back. You're right. Earnings have been surprising to the upside. Why are stock traders not necessarily impressed?
Lisa, could you repeat that again? You're right. I love that.
Okay, all right. You're right, Stephen. This sounds like a home squabble. Stephen, you're right. So carry on.
Lisa, these stocks have had big run. Like, look at Disney. It's almost doubled over the last year. A lot of these stocks have run into earnings. And so, traders are taking profit. That's pretty normal, actually. And we tend not, obviously, we're too big to trade the day. We don't really do that. But we look at the longer term picture, the next 12 months, we see a broad rotation out into everything else. Just starting to see it already. Disney's not like on our buy list per se, but it's one of those stocks that probably is going to participate in that rotation, right? It's relatively inexpensive. It's really been in a doghouse for a long time. It's starting to come to life. It's got a long way to go to get back to where it used to be 3-4 years ago.
So the numbers allow people who like to spin narratives to spin them in any which way they want to. And so it's kind of a field day for people who have lots of creativity and some time to do so. I am curious, if you do look at the earnings, it does look like any mention of uncertainty is punished. at a time where there's a lot of uncertainty. And some of the economic data has pointed to a potential stagflationary type of mix that definitely surprised markets. So which is it? Are people responding to that and penalizing that? Have people recognized those risks in valuations?
Well, yeah, I mean, the overall market's really not that expensive. Once you take out the Mag 7, which are kind of special, exceptional companies globally, right? You take them out, the rest of the market's trading around 19, 20 times. We don't think that's an unreasonable level, and we think it's the rest of the market where there's value right now in the market. So, I would call it's an environment where there's short-term uncertainty and long-term less uncertainty. I mean, if you look at the pattern of what's happening right now, as an example, when I was on a few months ago, we were talking about this. The soft data is signaling a slowdown. The hard data is still good. When is it going to catch up? The hard data, by virtue of the fact that it's hard, is rear view mirror stuff. It's what the Fed uses, as an example. I call it the cracked rear view mirror. We're in a news cycle here that's 24/7 now, more than ever. Trying to make forecasts based on hard data you're fighting yesterday's war. So the Fed is now coming around because the hard data is finally softening up. We've been screaming that they should be cutting way back in the spring. They're now going to do that. We're entering a cutting cycle. But the soft data is starting to turn. Look at things like air travel. Boom, it's spiking. The Dallas Fed's real-time economic indicators, it's up 100 basis points in the last month. You look at consumer sentiment surveys, up 10 points in the last couple of months. You got small business confidence indicators up 10% the last couple of months. You look at the market and the industrials, the cyclicals are starting to lead. You know, we do a lot of IPOs at Federated Hermes, right? I'm teasing the guys in the office. I've become the office receptionist after 5 p.m. I mean, I got these companies all showing up.
But Stephen,
right? I mean, that market has really picked up. That's not a sign that confidence is falling over amongst the people that actually make decisions in the economy. So we see all the soft indicators picking here, most of them. And, we're pretty optimistic, as you know.
For all that good news, though, what's been pricing in is the uncertainty of tariffs. They're actually going to bite, and we're going to have an average tariff rate about 15 to 20%. This time last year, it was 2.5%.
Yeah, I think you got to check the math on that, because the actual, remember that a lot of the goods that come into the U.S. come through Canada and Mexico. The goods that come in there through USMCA are 0%. Mm-hmm. So when Trump talks about these massive tariffs on Canada and Mexico, he's talking about trade that they've brought across the border that doesn't conform with USMCA, which in the case of Europe, if they were doing that, they'd throw them out of the union. So you've got to account for that zero part of the thing. The actual tariff rate on average right now, as we know it, is about 13%. We figure about half of that's going to be paid by the foreign importers. So you're looking at 15% of the economy's imports. Half of that is not going to be. You work out the math. It's about an 80 or 90 basis point price increase, probably spread over 6 months. There's all these other things that are decreasing in price: commodities, steel, oil, regulatory costs, taxes. Another way to think about what Trump is doing here is he's increasing a consumption tax, a pretty efficient one, by the way, because it's partly paid by foreigners. And he's using it to fund an investment tax reduction with all these accelerated. The multiplier on investment spending is multiples of what it is on consumption spending. So there's a kind of shift going on in the economy. I get the tariff thing is not that positive, but it's not as big of a deal. It's the one thing everyone can hang on to, so it's a good discussion point.
You mentioned the president a few times. He thinks you have great analysis, by the way, because I follow his Truth Social, and he has tweeted about you. Right now, he has what some would say undermined market credibility when it comes to hard data releases by firing the commissioner at the BLS, continually going after the Fed, and some are saying maybe it's going to be a very overtly political individual he'll put at the Fed. Do you think he's undermining market confidence?
A little bit. My advice to him, not that he takes my advice, but I don't think it's necessary to pound the Fed chair. As an example, on that case, I would just say, look, the Fed chair is a rear view mirror looking guy. he simply is going, stop listening to what he says he's going to do and just think about what he's likely to do. And we've been saying for a while he's going to start cutting in September. Now that the rearview mirror is looking like it should, he will. On the labor secretary, one reason that storm is passed, and I don't necessarily agree with the pressure there either, but one reason that storm is passed is because the reality is, let's face it, I've heard you complain on the air about the labor numbers. They've been terrible.
They have been.
There needs to be an overhaul of that department.
Well, there's a hiring freeze right now.
If he had positioned it from that perspective, it probably would have not even been a news story. But at the end of the day, people are saying, yeah, the labor numbers aren't really good. Yeah, the Fed, no, they've been a lot of bad calls here. So he's not completely off base with the pressure in these areas.
How concerned are you about inflation, given the fact that right now you look at backward-looking numbers that might constrain the economy, but the forward look is pretty rosy at a time where you do have some input pressures with prices?
Yeah, but the Fed's not looking forward, so I think they're going to cut.
So that's fine.
And the other thing is that, I look at the actual ongoing inflation rate here. It's kind of stabilizing around 2.5, it's right at 2.6, 2.7, but it's going to stabilize by next year, 2.5. That's really the Fed's informal target. I think they figured out a long time ago 2 is too close to 0 for government work. So assuming that, right, shouldn't the Fed funds rate, if you look at history, should be about 50 basis points above that. That's 3. So we have Fed funds going to 3 over the next 18 months. I think that's where we're heading here. And so I would just say I got 6 cuts coming against a backdrop that's pretty good. We have the Fed cutting not because they need to, but because they can. And now that they think they need to, they'll start doing it. And once they realize they can, they will.
Stephen Auth, he is the receptionist at Federated Hermes, where he offers lots of pigs in a blanket. Do you have your different snacks?
Water, tea,
yeah, exactly. Stephen Auth, the CIO of equities at Federated Hermes. Thank you. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahaira on Tiara.
Hi, Lisa. We have a flurry of earnings to get through. McDonald's shares are rising 3% after beating across the board in their second quarter results. Global sales rose nearly 4% year over year, ending 4 quarters of declining or tepid growth. The results suggest the company's focus on pop culture collabs and budget meals are helping to offset diners' concerns over the economy. Meanwhile, shares of Uber are falling nearly 3% in the pre-market despite forecasting higher than expected gross bookings for the third quarter. It is now calling for a 17% rise in bookings from the same period last year. The company also beat estimates on total trips in the second quarter and announced a plan to buy back up to an additional $20 billion in shares. And Disney shares are also falling 1.5% as its revenue from TV networks and sports programming fell short of street expectations, overshadowing strong performance in its theme parks and streaming business. Disney raised its full-year profit forecast, and CEO Bob Iger said Disney is taking major steps in streaming with its new ESPN service and plans with the NFL. The market is playing tough this morning. That's your Bloomberg Brief. Lisa?
Thank you so much, Ira. We also got earnings from McDonald's, and they also beat expectations. Comp sales in the second quarter coming in at 3.8% versus the estimate of 2.5%, really driven by their global business and an expansion there. The shares performing a little bit better, but it is early days. Up almost 3%, 2.75%. Up next, 100% tariffs.
Do you still plan to follow through on your threat to impose 100% tariffs on all countries that purchase Russian energy, including China?
Well, I never said a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time. But we'll see what happens.
Michael Townsend of Charles Schwab joining us next. This is Bloomberg Surveillance. Coming back with another day of potential gains. We've seen this movie before. Right now, getting higher on futures, up almost 0.25% on the S&P. What you're seeing is dollar weakness beginning once again, 116 on the euro-dollar cross. And yields bleeding higher, up 3 basis points now in the 10-year, 4.24% rounded up ahead of that auction later today. We are getting a slew of earnings, a lot of them beating the actual trading response, not exactly consistent. What we are hearing about, though, from the likes of McDonald's is an increase in technology spending, something that we will be talking about more going forward. Under surveillance this morning, 100% tariffs.
Do you still plan to follow through on your threat to impose 100% tariffs on all countries that purchase Russian energy, including China?
Well, I never said a percentage, but we'll be doing quite a bit of that. We'll see what happens over the next fairly short period of time. But we'll see what happens. We're taking in trillions, not billions, trillions and trillions of dollars from other countries who, for years, took advantage of us. They took advantage of the United States like we were children. And that's not happening anymore.
Here's the latest. President Donald Trump touting the substantial revenue stream from his tariffs. The president also pledging to increase tariffs on countries buying energy from Russia and introduce levies on chips and pharmaceutical imports, quote, within the next week or so. Bloomberg's Tyler Kendall joins us now. Tyler, how much are we understanding what the red lines are for President Trump to put these really more punitive tariffs on Russia?
Well, Lisa, that's one of the key questions that we're going to be looking into here, considering that President Trump did say within the next 24 hours, India, for example, could see a heightened tariff rate over its purchase of Russian energy supply. So perhaps we'll get an update later today, as the White House really does appear to be doubling down on its threat of these so-called secondary tariffs on those trading partners that import Russian oil, for example, which means that China could also be facing some higher levies. Now, the president had previously said that this rate could reach up to 100%, but as you heard him there, he sort of downplayed that idea, said he had never named that rate. So that could indicate to us that that tariff could actually come in a little bit lower than expected. But if we look at just India, for example, data shows us that India makes up about 37% of Russian oil exports, and those barrels are likely just to be diverted elsewhere. So our analysts at Bloomberg Economics say that this is really about gaining leverage in the trade talks more than anything else. But still, we know that Russia is trying to stave off any sort of economic penalty here, and our reporting indicates that there could be a few concessions that are actually on the table to try to get ahead of it. People familiar do tell Bloomberg News that the Kremlin is considering floating a potential air truce in the fighting. Now, to be sure, the understanding is that Russian President Vladimir Putin is not going to be in favor of a full ceasefire, but perhaps an air ceasefire could be on the table to try to appease or get some sort of concession from President Trump. Lisa, of course, this comes against the backdrop that Special Envoy Steve Witkoff is negotiating with Russian President Vladimir Putin. We can confirm that he is in Moscow and that those negotiations are underway.
Tyler Kendall, thank you so much for that reporting. Joining us now is Michael Townsend of Charles Schwab. Michael, tomorrow is the deadline day. It is August 7th when a lot of these tariffs do go into effect. What exactly will happen tomorrow?
Well, I think the market has already anticipated that this is going to take place. And I think what's tough for the market right now is every day seems to have 2, 3, 5 announcements about tariffs that may happen later, some number that may come up. We heard just now that the pharmaceuticals and chip tariffs, which have been threatened for a while, may come next week. We've got this idea that there'll be increased tariffs on countries dealing with Russia. So, I think the market is just trying to tread water and sort of ride this wave as these announcements continue to come, and we'll see how it plays out. But in terms of tomorrow, I don't think there's a huge market reaction, just given the lead up that the preparation time that's been already out there.
Michael, do you think Switzerland's able to get a deal done before midnight?
Yeah, it's interesting. The Switzerland thing was a little bit of a head scratcher with the 39% tariff on imports from Switzerland. And they're in a little bit of a tough spot because, of course, they already don't have very many barriers that they can lower. So it'll be interesting to see what they come up with. I think they're really eager. Obviously, there's a delegation that's traveled here to try to make a deal. So we'll all be watching to see what happens.
When it comes to other announcements we're waiting for the president, he says we're going to get the new name of the BLS commissioner as well as who will fill Kugler's seat. Do you think the administration is looking at someone who could be elevated to the chair position, or do they want someone just to fill her term out basically till January?
Yeah, I think this is an odd situation. And of course, the key here is that Chair Powell, his term as chair ends in May of 2026, but his term as a regular governor continues on for a couple more years. Now, it would be historically really unusual for him to step down as chair and stay on as a governor, but he's been pretty evasive in answering that on whether he's going to do that. And I think that's why this sets up this kind of tricky situation with Kugler's seat, because there's a possibility that there will be no vacancy later on when Powell's term comes ending as chair. So I think the White House has to determine whether they want to put in someone to that seat who could be elevated to chair. Of course, that person would then have to go through a second confirmation hearing at the Senate. So it's a little bit of an unusual situation, and I don't think the White House has decided yet exactly how they want to approach it.
In the policy roulette that we have this week, another one has been the Bureau of Labor Statistics and exactly how things get reshuffled there, who becomes the executive director of that organization, given its importance to the entire market. There have been a lot of criticisms about how this data was collected, the integrity of the data, the fact that there haven't been as many people and the response rate's been coming down. Have you gotten a sense from the administration, anybody there, about what they plan to do to actually improve the integrity of the data versus just getting rid of the top person?
Yeah, Lisa, I think you've hit on the sort of two-headed dilemma that they have here. You know, they're going to have to replace the head of the BOS. But there's a much deeper issue that's been going on for a while. As you mentioned, the response rate has been gone down quite a bit, particularly since COVID. Really hasn't rebounded at all since COVID. So it was up in the 60+% response rate. Now we're in the low 40s. And I think that's a big factor. The staffing issue and the inability to hire and fill open positions. We saw earlier this summer that the BOS is reducing the number of cities that it's taking consideration of in its surveys. So I think there's some real honesty in there about the need to kind of look holistically at what the BOS is doing. I'm not sure firing the BOS head was necessarily the right way to go, but they're going to try to put someone in there who's going to really take a look at how this data is collected, and I think that would help give some more confidence to the data for the markets.
Michael Townsend of Charles Schwab, thank you so much for being with us as we try to parse through the landscape going forward. Look, this is going to be a serious question, and people can say it looked a little bit like shooting the messenger. That said, when you take a step back, there has been a lot of criticism and concern on Wall Street about how this data is collected. It puts a spotlight on trying to increase the ability to actually glean data in real time rather than after the fact.
When it comes to, though, the new BLS chief, Libby Cantrell of PIMCO had a great note out saying that it needs to be someone that's not overtly political, that does have market credibility, because actually it needs to get through committees in the Senate that have individuals that are not scared to speak out against Trump, like Senator Ron Paul. So it's going to have to be someone that is credible, not just for the market, but to make sure that he can get that Senate approval.
Yeah, coming up, we're going to be speaking more about that and squishmallows, which evidently Annmarie has become an expert in. Anastasia Amoroso of Partners Group on what she calls the long-awaited quarter of adjustment. Plus, Danny Berger with your morning movers, also Minecraft and how that is boosting Happy Meal sales. This is Bloomberg. Some heated discussion about Squishmallows and Labubus, as well as the Coca-Cola series Labubus, which we are not going to get into. Right now, we're seeing
they go for $110.
Evidently. I mean, who knew, right? Are you into that whole trend?
I think they're kind of ugly cute. I'm not going out and buying them, but if McDonald's did something with Happy Meal, maybe I'd go buy the Happy Meal to get the toy.
All right, well, this is the reason why we're talking about this to begin with, because McDonald's came out with their earnings, and Squishmallows and Minecraft-themed Happy Meals seem to really boost some of their activity. I think about when I was a child, I would have loved that. Anyway, moving on. Right now, futures are rising across the board, up 0.25% on the S&P and NASDAQ, up a bit more on the Russell 2000, 0.3%. 2 hours away from the cash open. Here are morning movers away from Squishmallows with Danny Berger.
I'm going to disappoint you, Lisa, because I am going to get to McDonald's, but let's not start there. Let's start with Disney. We got their earnings coming in, and it was a disappointment despite the fact that they did well with things like streaming and their parks business. Instead, it was their linear TV that disappointed, and shares falling 1.2%. They also announced late yesterday that they would be buying some more NFL media assets. Still, that's not enough to get us excited this morning. We also had earnings from Uber. It's been on a wild ride, shares, since they announced earnings. Truly, no pun intended. We are still down 1%. That's despite the fact that they beat and announced a $20 billion buyback. The issue maybe from them was that their beat mostly came from their delivery business, the traditional ride-hailing business not doing as well, and even a bit of a disappointment there. Okay, McDonald's, I promised you we'd get there. Here we are. Shares are higher by 3.2%. It was a sales beat for one. It's just a more value-oriented consumer, maybe liking cheaper meals from McDonald's, winning out after 4 quarters of declining or tepid growth. And it was the Minecraft and the squishmallows of the whole thing. I'm going to be honest, guys, I don't think we're the target audience for that.
Well, maybe. It depends on how our childhoods were. Danny, thank you so much for that. And I will just say, actually, this is something that's actually quite interesting. McDonald's talking a lot about technology and how much they're investing in technology and how it's driving a number of gains across the board. Really closely watching that in all of the earnings calls. Do we see a broadening out in this AI trend to companies not considered tech companies? On our radar this morning, President Trump vowing to boost tariffs on countries buying Russian oil and saying pharma and chip tariffs will be announced soon. His comments coming as Switzerland's president heads to Washington today, hopefully has a meeting or two there. I'm just wondering how much you put this together and get something that we don't already know, or is this already baked in?
I think it's fluid in an idiosyncratic way. So we know that a number of tariffs are already baked in. The deals have come out. Already you've seen at the border, the computers have already been processed what the new rates are going to be. When it comes to India, when it comes to Switzerland, what's going on with Russian crude, this is where the situation is fluid. And I think the president even insinuated that. They have a number of options they could do when it comes to Russia and trying to squeeze Putin and make sure that he's not benefiting from shipping this oil to India or China. But there's a meeting going on right now between Steve Witkoff and President Putin. It feels like they're giving Putin one final moment to potentially do something to work towards a ceasefire agreement before they decide to go down the sanctions or tariff path.
Yeah, do something could mean some sort of air ceasefire, something of that nature. Meanwhile, there's a real focus on the chip sector, as that has been such a huge driver of all earnings and American exceptionalism. The U.S. arresting 2 Chinese nationals related to an NVIDIA chip export breach. Authorities saying the defendants have been charged with allegedly sending tens of millions of dollars worth of advanced AI chips to China in violation of U.S. export restrictions. Again, going back to this question, how do they create some sort of equilibrium where they're not sharing the crown jewels, but they are dominating the chip industry globally?
When you talk to the hawks in Washington, it's all about making sure that the tech does not leak to China. And this is why the administration has been so focused on transshipment. When you look at the data behind this company, the records and other business documents indicate they sent at least 20 shipments to shipping and freight forwarding companies in Singapore and Malaysia, but never received payments from those entities. This is according to the Justice Department. They received, instead of, quote, numerous payments from companies based in Hong Kong and in China. And this is what is so challenging about trying to figure out where all this tech is going. And this is why this administration is really focused on transshipment.
I wonder if this is why we're not hearing anything about DeepSeek anymore, if people are looking at the potential for some of these to have been used in the creation of some of those more efficient AI programs. Meanwhile, as we look forward to this question of what might actually happen with employment, the bank sector, fascinating to me. Bank of America pushing its junior bankers to disclose if they've accepted jobs elsewhere. Sources telling us here at Bloomberg, management is telling them that they face redeployment if future offers are accepted, going to this feeling that PE is going to poach some of the talent after training programs at the big banks.
John's not here, but I'm totally with Fargo on this. Just have them sign some sort of contract or NDA, something where you know that you are going to stay at this company. This has become almost for all the banks, this, whether or not it's a loyalty test, etc. But the bank's case is that we go out, we spend a ton of money, time on recruitment, we train all these people and they leave right away. So I understand their point, but then just put something in place so they can't leave or give them better jobs.
There's a larger point here, and I think it's an important point, which is who pays for the training? At a time where there are skills that are shifting so quickly, who pays? And how do you incentivize companies to do so, especially if other companies are going to piggyback on their training programs that might not ultimately benefit them. And this is going to become an increasing question, especially with AI and how quickly people have to learn new skills. And I think that is something that's important.
It is, especially when you look at the unemployment rate when it comes to men and women coming out of college right now. And this is something Governor Waller was talking about, 7% unemployment rate for recent graduates. To your point, who is training these individuals? And do we need to be training these individuals because more and more companies are looking to AI?
Yeah, well, turning back to markets, we are seeing stocks looking through all of this, looking to rebound after the S&P 500 posted its 5th down day in the last 6. Anastasia Amoroso of Partners Group writing this. This is a long-awaited quarter of adjustment, and the market may need to act accordingly, expecting less upside and more choppiness in Q3. Anastasia joins us now. Great to see you. Thank you for being here.
Good morning, Lisa.
All right, so this is the adjustment that everyone is expecting, that everyone's looking to buy into. How do you get an adjustment? And I asked this question yesterday. How do you get a sell-off if everyone's looking to buy the dip?
Well, I think the news flow is going to dictate that. And we need to have more Caterpillar-like reports that talk about the tariff hit that some of these companies are going to have to absorb. And some of that may be in line with consensus expectations, and some of it may not. I think that could be one trigger for a potential pullback as we really do realize the tariff hit. The other trigger, of course, is inflation. And inflation expectations for next week are somewhat subdued, but could we see some potential surprises there? So, maybe, Lisa, the move here in the market is not necessarily tremendous downside because I think some level of expectations already baked in. But that's why I really kind of call it the quarter of choppiness, because on the one hand, we need to market some of these tariffs. And at the same time, we also know that if the labor market weakens as a result of that, then that sets us up for a September cut. And I think that's what the markets are caught in between. And that's why we sort of get the back-to-back days of selling and buying and selling and buying. And I think that could continue.
And that's the reason why you're seeing some selling, even on the heels of earnings reports that are really positive, which we've seen increases to forecasts that beat expectations, and then the likes of AMD selling off. I'm just wondering, what do you do with the chop?
Well, I think for public market investors, if you have any sort of pullback, of course, you step in and you sort of buy your favorite names. And I would say, for us, it's really about long-term investing at Partners Group and focusing on thematic investing and really aligning yourself with some of the key secular growth themes. As much as we worry about the next inflation report or the next, rate cut or not, what truly determines whether the company is going to outperform or not is whether it's aligned with a long-term trend of, let's say, artificial intelligence or perhaps healthcare innovation or new way of living, and whether you align with that and benefiting from that. So, if there is an opportunity to buy into that in public markets, that's great. For us, I think there's a lot of deal activity that we're looking at, and given the clarity of tariffs that is emerging, I think for the private equity industry in general, the deal activity is likely to pick up.
Is it the clarity because the rates are set? Or is it the clarity that they're not as bad as some would expect?
Both. I mean, Annmarie, we put this chart together, looking at the percent of world GDP that had a deal in place. Back in April, it was 0. Nobody had a trade deal done with the United States. And today, you fast forward to today, and about 30%, about 28% of the world GDP has some sort of a deal in place. And there's still a big chunk of global GDP that's in negotiation. So that's the first point, is that, you have predictability, you have some clarity for a growing share of GDP. The second point is the one you made, which is, for most countries that are able to negotiate a deal, they're doing so at a lower tariff rate that could have been under the Liberation Day announcement. So I think it's both of those things. And then the third point is, now that we have the numbers, now that we have the certainty, we actually know how to price things. And this is why I say some of the deal activity can also move from being contemplated to actually being materialized, because we know exactly what we have to pencil into the models.
But what happens when the higher rates, which is a much higher average rate than we had last year, actually starts to get digested in this economy? 2.5% versus 15%, 20%, depending on the country.
Right. Well, that's why I call this a quarter of adjustment, and it's going to happen this quarter. If you think about, for example, the tariffs that were back in April, about 3%. Now the tariffs have ratcheted up closer to 10%, and I think most of that is being collected now. And in the next month or two, we're going to see 15 or 16% that's collected. But one thing that I will refer back to the Caterpillar report that I found interesting, they very much talk about profit margins, including the tariff hit, but also profit margins excluding the tariff hit. And that really suggests to me that companies as well as the Fed, are treating this as a one-off adjustment that they need to take and they need to process. And I think it happens in Q3.
As you see the pipeline of opportunities in the private markets really build steam, you buying into OpenAI at $500 billion?
I will defer to our investment teams on that. But, I think valuation is something we take very seriously. And look, I will say, Lisa, broadly speaking, in private markets, it's where can we find the most robust margins and where can we find the fastest growth rate and EPS, and how can we actually build that? That's what we're focused on.
Building rather than maybe buying into after the fact to give $100 million bonuses to all the people to have them stay in place. Although that might be the benefit for some of these strategies. Anastasia Amoroso, Partners Group, thank you. Wonderful to see you, as always. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Swiss President Karin Keller-Sutter will meet with Secretary of State Marco Rubio on her emergency trip to lower the U.S.'s 39% tariff on Switzerland. The meeting is scheduled this morning in Washington, but the Secretary of State's department does not lead negotiations for bilateral deals, and it remains unclear if she will get to meet with President Trump. Meanwhile, Novo Nordisk has reported its weakest sales growth in 4 years. The drug maker is losing ground to Eli Lilly in the U.S. market for obesity drugs. Novo Nordisk's earnings were below analyst estimates, and a new president and CEO is set to take over on Thursday after the company ousted its longtime leader. Shares are down 3.8%. And as you were discussing, OpenAI is in early talks about a potential share sale for current and former employees at a valuation of about $500 billion. People familiar with the investment discussion say existing investors have approached the company about buying some of the employee shares. If the deal goes through, it would increase OpenAI's on-paper price tag by about 2/3. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, AI's threat to workers.
I'm a net optimist of AI rather than thinking that it's going to take every job. Every single job will need to get reconfigured slightly, but this is no different from any other previous technological revolution.
Joseph Briggs of Goldman Sachs joins us next after writing a report exactly on that topic. This is Bloomberg Surveillance. Good morning. We are seeing some gains to start the trading day. A little bit of a lift under the hood as people take a look at earnings and policy. Up about 0.25% in S&P futures. Dollar weakness, 116 on the euro-dollar cross, and yields bleeding just 2 basis points higher, 4.23% on the 10-year ahead of that auction later today. Under surveillance this morning, AI's threat to workers.
I'm a net optimist of AI rather than thinking that it's going to take every job that's available for humans right now. Every single job will need to get reconfigured slightly, will need to have be adjusted, but this is no different from any other previous technological revolution that we've had. Let you have an entry-level candidate with AI as a companion, you can start to see meaningful levels of compounding of value.
Here's the latest. Goldman Sachs' global economics team has published a new report suggesting artificial intelligence will displace 6 to 7% of the workforce. But the team says it's skeptical that artificial intelligence can cause large employment reductions over the next decade. Joseph Briggs of Goldman Sachs joins us now. Joseph, great to see you. Thank you for being with us. A topic that has ignited our curiosity and our imaginations for quite a while. Is 6 to 7% job loss a good number or a bad number when it comes to what it means for the overall employment picture?
So a 6 to 7% rate of displacement, following the full AI transition, once we've seen AI be deployed everywhere in the economy that we think it ultimately will, it's broadly in line with what we've seen in past technology cycles. If we look at the IT revolution, the widespread adoption of the internet, of software, we saw rates of replacement in the 5 to 10% ballpark. And so generally speaking, I think that what we're expecting is roughly consistent with history. And ultimately, I think it's going to be a manageable headwind for the labor market.
The words that people don't want to say in markets is this time is different. But a lot of people do mention the speed in which AI is transforming roles, businesses. And we see that in some of the earnings reports and some of the companies that are coming out and having to train workers in real time as they figure out the tools themselves. How much does that really change the picture, the sort of timing mismatch of how quickly the technology is moving and how quickly companies and workers can really adapt?
I think the speed is the most important thing to be watching when thinking about how large of an impact and how quickly and how disruptive of an impact AI has on the labor market and broader economy. Now, if our estimate for 6 to 7% displacement occurs over roughly a decade, which is what we have in mind in our baseline forecast, then that's a very manageable headwind. You're looking at roughly a half-point boost to the unemployment rate in any given year. It matters, but it's not going to be a significant macroeconomic driver. If instead, however, we're wrong, and we see that those 6 to 7% of workers be displaced over a 2 to 3 year period, all of a sudden you're talking about a 2 to 3 point increase in the unemployment rate. And that's a very different macroeconomy.
So when you say full transition to this AI new economy, that's a 10-year period?
When I say full transition, what we mean is that AI automation has been deployed in every area that it can possibly be deployed. And so the 10-year transition, I get the feedback a lot that people think that this is too bearish or too cautious of an estimate. I'm very sympathetic to the idea that there are going to be some areas of the economy that adopt sooner. We're seeing that very clearly in the tech sector today. But when we're thinking about unlocking the economic value on a macroeconomic economy-wide basis, you need to have every doctor's office in Colorado and every law office in Ohio utilizing the technology to its full capability.
What do you think we're seeing right now? There are some pretty eye-popping numbers when it comes to young men that are unemployed right now, age 20 to 24. That unemployment rate is 8.3%. And for recent college graduates, the annual rate is 5.3%. For young men, there's almost recessionary levels of unemployment.
The youth unemployment rate has definitely risen. And I think that mostly reflects that we're in a low hiring and low firing labor market right now. And so the increase in unemployment for young workers, I don't think for the most part is related to the AI impacts that we are seeing in very narrow areas of the economy today. The one area that stands out as different is the tech sector. We have seen tech sector youth unemployment rise by 3 percentage points since the start of 2024. This is a larger increase than what we've seen for young workers broadly speaking, and a larger increase than we've seen for the tech sector overall. And so it's not surprising that it's having a bigger impact in areas like tech where adoption has started to pick up.
But to Annmarie's point, isn't that just a precursor of what's to come, given the fact that they can adapt a little bit more quickly to some of the AI tools?
Yeah. And we are expecting that adoption and utilization of AI is going to broaden out over the next several years, which is why we are ultimately expecting that there will be a 6 to 7% replacement and displacement of workers that need to be reallocated to new positions. Our view is that the tech sector is the first, but other industries will just take a little bit more time, and it will play out over a longer period.
How disinflationary is this? And I ask at a time where people are trying to extrapolate out tariffs and other policy changes that could be inflationary and saying AI will cure everything. Is this something that really will reduce costs in a material way?
Again, it really comes down to the speed of transition. That if you only see a half-point boost to the unemployment rate in any given year, which again is our baseline expectation, then you're only looking at a tenth or two of downward pressure on inflation from labor market slack. If instead it happens much more quickly, then the inflation impacts could be much larger.
Building on Lisa's point, this is coming at a time we're seeing a tremendous amount of changes when it comes to policy. This is an administration that is trying to bring back manufacturing to the United States. Will some of these jobs they're trying to be back even exist in 10 years?
So I think that the policy angle, when thinking about how it interacts with the macroeconomic impacts of AI, it really is going to determine how quickly we see adoption occur. The U.S., relative to other countries, has taken a lower touch approach to regulating AI. The U.S. is the leader in AI technology and AI capability right now. And so generally speaking, I think that means that it will have a more front-loaded and more significant impact on the labor market and productivity over the next 5 years than we'd be expecting in other countries. But ultimately, I think that the impact on the labor market and the speed is going to be the main effect.
When you look at other countries, specifically China, because it's like this arms race when it comes to AI between the United States and China, how far behind is China?
It's hard to have a lot of insight from a technological perspective. The DeepSeek news earlier this year already obviously highlighted that China has the ability to develop, a very powerful and very effective AI model. Earlier this year, we did pull forward our adoption timeline, for China so that it's only lagging the U.S. by about a year or two. And so we are expecting that China will not be too far behind in the U.S. in deploying the technology.
What's been the response like to this report?
It's been all over the place. Some people say we're way too optimistic. Some people say we're way too pessimistic. If you talk to tech investors, they think that the effects are going to be much larger.
What about corporate executives that are actually coming out with different training programs? And a lot of big companies, they have training programs to try to figure out how to implement artificial intelligence, large language models into everyday existence of their employees. What's their response been like to this?
I think corporate executives are generally taking a cautious approach to deploying the technology. If we look at survey evidence, concerns around privacy, concerns around figuring out how to actually integrate AI into regular production, and furthermore, just concerns about making sure that you get it right has led to a slower adoption curve. Now, we are seeing adoption pick up more among larger companies. Companies with more than 250 workers are seeing adoption in the mid-teens right now. But I think that, generally speaking, the feedback has been that we do need to take this a little bit slowly and make sure that we end up getting into the right place in the long run.
Joseph Briggs of Goldman Sachs, thank you so much for being with us. Joseph Briggs there with his report on artificial intelligence and what it will do to the labor market. You looked at that 67% number and you thought, oh my goodness, this potentially could be catastrophic, and it could if it is executed over the next couple of years.
I was depressed reading Joseph's report, and you were optimistic because you didn't think it was as bad as potentially it could be.
Well, if you looked at Anthropic, for example, where it was like Jobmageddon, right? And everyone was going to lose their job and we'd all just be subject to domineering robots telling us to just work harder and sit in a corner, that's probably a more optimistic look. Look, it does seem like there's a huge transition underway. How quickly it happens remains to be seen, as well as exactly how companies deploy that.
And I think the report does highlight that this is going to take, for full transition, a decade. So potentially this is not just going to happen overnight, which is to the Jobmageddon point.
Meanwhile, we are getting earnings, and a number of these companies are mentioning just how much they are investing and using a number of these technologies, and McDonald's among them, Uber reporting earnings, as well as Disney. Coming up, we'll parse through all of that and look ahead to tomorrow's jobless claims, as well as the auction. At 1 p.m. today, Darrell, Cronk of Wells Fargo, Rich Greenfield of LightShed Partners on those Disney earnings, the ESPN NFL tie-up, Marc Giannoni of Barclays, and Winnie, Cisar of CreditSights. This is Bloomberg Surveillance.
The leadership is clearly still coming from the top.
Markets are showing historically high levels of concentration.
It's all about tech earnings. All eyes are on tech.
There's a lot of high expectations in big tech.
At the end of the day, what's going to matter for this equity market is the earnings growth.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on a busy day of earnings. It's the heart of the earnings season. We've gotten Disney, Uber, and McDonald's, Airbnb after the bell. The message from companies, we're doing really well. The message from traders is just not good enough after having some pretty high expectations. We're squaring positive earnings forecasts with yesterday's stagflationary ISM report and plenty of uncertainty on the tariff front. John still on his jaunt through the fjords of Norway on a cruise, and Annmarie, you and I keeping the fort warm. I am curious, though, how much we're getting noise versus signal from how people are responding to some of these earnings reports.
Well, it's interesting because we had Uber shares actually go down, but now the market is taking them in stride and saying, actually, this report looks really good. Announced $20 billion in new stock buybacks after a better than expected third quarter forecast. McDonald's, though, really interesting. The global footprint seems to be where they're getting a lot of growth. Also, who knew? Toys and budget meals driving people to want to go to McDonald's, and something you've been talking about a lot, but you can actually see if you go to any McDonald's, whether it's United States or internationally, how much they were relying on new technology and AI to basically create a more efficient environment.
Yeah, this goes to what Stephen Auth was talking about as we asked, how do you square some of these positive forecasts that we're seeing from these consumer-facing companies with the stagflationary ISM report where you saw really stagnating top-line growth or sort of compressing employment picture as well as inflationary inputs with a pretty rosy environment that we're seeing at companies. How do you understand what the picture is? And he said, these are forward-looking, and that was backward-looking.
Yes, he says the Fed is just backward-looking rearview mirror. Now they're seeing the cracks in the rearview mirror, but companies are forward-looking. But what did Anastasia Amoroso say? She said this is going to be the crunch times in terms of the choppiness to figure out the uncertainty that's been baked into the market has been the uncertainty of policy out of Washington. Well, now, for at least a number of countries, we have certainty what these tariffs are actually going to actually be, and companies are going to have to digest them over the next few months.
And that uncertainty, when it is represented in earnings reports like AMD, it can be problematic for their share reaction after markets. Right now, it's less problematic. You see shares, you see futures higher ahead of the open as people look through some of these more positive reports of about 0.2% on the S&P, really led by what we see in the Russell 2000. As people do price in more than an 80% chance of a rate cut next month, we do see a bit of dollar weakness, 116 on the euro-dollar cross, and yields just creeping marginally higher. We do have that 10-year auction, $42 billion of notes sold today at 1 p.m. Eastern. Coming up this hour, Darrell, Cronk of Wells Fargo with stocks looking to rebound. Richard Greenfield of LightShed Partners reacting to earnings from Disney as well as that tie-up between ESPN and the NFL. And Marc Giannoni of Barclays on expectations for the Fed's next rate cut. We begin this hour with stock markets digesting a rush of earnings reports. Darrell Cronk of Wells Fargo writing, with stocks seeing 32% gains over the past 80 trading days, some sort of pause and consolidation is likely warranted before the next leg higher. Darrell, you are not alone. He joins us now. Really good to see you. Thank you for being here. It does seem like this is sort of increasingly consensus. Watch for the chop. Get ready for some sort of pullback. We've seen this from Morgan Stanley's Michael Wilson. We've seen this from Bank of America's Michael Hartnett. How do you identify some sort of sell-off before it even happens and then say it's an opportunity to buy?
Yeah, I think that's a good question. And we just literally yesterday put out a whole report about pulling money out of small cap equities, pulling and trimming large cap. We're still on the favorable side of large cap exposure because you got to be up in quality, and took that money and put it in intermediate fixed income, right? Just because we think we added to equities twice in the spring, March and April, right around Liberation Day. Better lucky than good, I guess, right? But huge move, obviously, in equities, right? At this point, at 24 times earnings, right? Yes, I love the earnings numbers, right? Remember, first quarter was 7% revenue growth or sales growth and 15% earnings growth. Right now, we're tracking 6% revenue growth and 10% earnings growth. Like, I'll take that all day long after the last couple of years we've had. So earnings are finally catching up to try to squeeze those multiples down a little bit. But look at something like small caps, which we're not a buyer of. I just told you we took money out. If you go back 3 years, small caps have underperformed money market funds, literally. Like if I got 4.1, 4.2% in a money market fund for the last 3 years, I did better than if I had small cap exposure, right? So people keep looking, waiting for Godot, right, for the time when small caps are going to come roaring back. We just don't see it.
All right, so put small caps aside. They have been sort of like the stepchild of the market over the past number of years. When you take a look at the golden child, which has been big tech, a lot of people saying it's looking a little frothy. It's gotten pretty elevated, and that's kind of what we saw from AMD yesterday. They came out with pretty good numbers, and people sold off because they can't see the future. I mean, how much is that really where some of the pullback is destined to be?
So we didn't downgrade tech, but we did downgrade comm services, which has been just rip-roaring good. And we actually downgraded energy as well and put that money into financials, right? We still see financials with a steeper yield curve. What most people don't realize is they know well that the 2 to 10 spread on the treasuries is 50 basis points, which is a nice steepness. If I look at the 2 to 30, it's 107 basis points of steepness. The roll down effect and what that does for financials is extraordinarily good. Then you add in deregulation, you add in the M&A environment picking up, you add in what will kick in here shortly with corporate buybacks. Like there's some real opportunities to do that. In tech, though, you still have to be where growth resides, right? If I look at the top, the big four, right? Alphabet, Amazon, Microsoft, Meta, 29% earnings growth this quarter. And if I take everybody else, minus those big four, 2% earnings growth. right? So you still have to be where growth resides. You can't underweight tech, especially when the top 10 names now are 40% of the index.
Would you change your allocation if we get the Fed cut in September?
No. Because the Fed cut's already priced in, basically. It's a good question, but I think where the market is wrong is not on September. It's wrong on it's got 55 to 60 basis points in the futures curve through year-end 25, so call it 2+ cuts. And then next year, it's got 3 to 4 more cuts, right? So if you look
So what's wrong about it? What do you think
too
it's
many
going
cuts.
to be?
We don't think the cuts will come to fruition, just like the bond market's been wrong. You know, we can go back and count numerous times over the last 3 to 4 years where they priced in too many cuts, then had to walk them back out eventually. If you're going to tell me we're going to get 6 cuts in the next 15, 16 months, then I'm going to tell you the economy is very much weaker than what we are projecting and planned.
So what are you projecting, at least for this year?
So if you get under the surface, right, the economy is close to stall speed. This second quarter, 3% GDP, right, besides 1% consumer growth, nothing in CapEx, nothing in government, and then you look at, what trade did, which is 5 points, and you subtract off the 3.2 points on inventory, you're looking at 1 to 1.5% growth at the underlying, right, for the economy. That's close to stall speed. And so we think as you go through the second half of this year, you got to be careful, right? We do think it'll pick back up in 26. I think what's interesting, so think about this for a second. In May, 70% of economists predicted that the U.S. economy would go into recession following Liberation Day, right? All the tariffs and everything. Today, it's probably 10, 15%. But if I add up all the tariffs from Liberation Day, it looks like, who knows, headlines, negotiations, about 60, 65% of those are going to actually get enacted. So if I believed...
But not at those high rates.
At the rates that were announced in Liberation Day. If you actually go back and you start pulling apart all the Liberation Day announcements and say, how much of those are still likely to happen, right? Either have already been negotiated or likely to happen, it's about 60, 65% of them. So if I thought, it probably suggests that in May, economists were way out over their skis, that 70% was too high on a recession. There is a risk today that 10 to 15% could be too low, right, on the impact and the slowing growth into the back half of this year.
What kind of retracement are you looking for in equities right now?
Hopefully, we're thinking, somewhere in that 6 to 8, maybe 7 to 10%. And if we get that, we would probably be buyers again, right? We'd take that capital and put it back in tactically. Because that's really what this is about. It's not about some risk-off move that we think the markets are going to roll back over 19, 20% like we did in April.
Will the U.S. markets be in isolation of the rest of the world? This has been sort of the debate for a lot of people this year, how much this is time to go international, right? We've heard that many times. It reminds you the rest of the world actually has companies as well, and you can invest in them. How much does that reiterate that kind of move versus we're going to get the same amount of pain, if not more, elsewhere?
I think the latter, right? They're going to get the same amount of pain, if not more, elsewhere. We didn't believe in the international piece, right? And let's be honest, we've been wrong on that side of it for the first, 6, 7, 8 months of the year. You go back and look at the last 7, 8 times international has outperformed domestic. It's usually about 6 to 9 months, and that trend rolls itself over, right? It doesn't sustain. We know it hasn't sustained. So history is on your side that it's going to take something to really, again, durably beat expectations there. A huge piece of that, as you guys know, has been the dollar's decline that's favored that. We don't see another 10% downside in the dollar. A lot of the street does, right? We think the dollar consolidates here and actually rebounds a little bit or steadies and maybe surges back higher, which isn't going to help international. Right? If anything, it's going to put a little bit of a tailwind in domestic. So we never believed in the death of U.S. exceptionalism. We think domestic over international still makes sense. We think large over small still makes sense. And then we think we got to be really selective in the sectors.
Darrell Cronk, thank you so much for being with us as always. Darrell Cronk of Wells Fargo here in New York with us right now. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. Russian media reporting a meeting between President Donald Trump's special envoy, Steve Witkoff, and Russian President Vladimir Putin is over. Talks in Moscow went on for nearly 3 hours. The meeting comes just 2 days before the August 8th deadline that Trump set for Russia to reach a truce with Ukraine or face potential sanctions. Meanwhile, OpenAI is in early talks about a potential share sale for current and former employees at a valuation of about $500 billion. People familiar with the investment discussions say existing investors have approached the company about buying some of the employee shares. If the deal goes through, it would increase OpenAI's on-paper price tag by about 2/3. And Novo Nordisk has reported its weakest sales growth in 4 years. The drug maker is losing ground to Eli Lilly in the U.S. market for obesity drugs. Novo Nordisk's earnings were below analyst estimates. Meanwhile, a new president and CEO is set to take over on Thursday after the company ousted its longtime leader. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. I got to say, the race to make people skinny this earnings season has been fascinating. Up next, the morning calls plus Rich Greenfield of LightShed Partners reacting to results from Disney. That's next. This is Bloomberg.
The move here in the market is not necessarily tremendous downside because I think some level of expectations are already baked in. But that's why I really kind of call it the quarter of choppiness, because on the one hand, we need to market some of these tariffs. And at the same time, we also know that if the labor market weakens as a result of that, then that sets us up for a September cut. And I think that's what the markets are caught in between. And that's why we sort of get the back-to-back days of selling and buying and selling and buying. And I think that could continue.
That was Anastasia Amoroso of Partners Group talking about that chop that we keep hearing about. And certainly we're seeing that chop yesterday, down today. Futures up as we look ahead to another day of earnings, although really off some of the earlier intraday highs, up only now about 0.1% on S&P futures. Seeing that dollar weakness gaining steam, although that has really been going nowhere. The DXY index yesterday kind of hovering around the same place, 116 on the euro-dollar cross, and you're seeing yields just marginally higher ahead of that 10-year auction later today, 30-year auction tomorrow. Time now for the morning calls. One stock very much in focus, AMD. First up, Stifel raising its price target on the stock to $190, saying it is a, quote, strong participant in artificial intelligence. Those shares were down almost as much as 7% earlier this morning in early morning trading, now down less than 5.5%. Next up, Raymond James raising its price target in AMD to $200, expecting new product launches next year to accelerate its artificial intelligence momentum. And finally, JP Morgan raising its price target in AMD to $180, saying it expects better share gain in its chip business. And this, of course, as a whole host of uncertainty swirls, given what's going on with China and their ability to penetrate that market. Turning to media, Disney shares sliding in the pre-market despite the company raising its full-year outlook. Joining us now is Geetha Ranganathan of Bloomberg Intelligence. Geetha, thank you so much for being with us. What stands out to you from this earnings report?
Yeah, thanks, Lisa. So definitely it was a beat. They delivered really strong fiscal third quarter results, and it was, guidance raised. So EPS now up, full year EPS now up 18% versus 16%. Again, on Parks, what we were expecting, a strong operating income growth. Again, they reaffirmed guidance there. I think why we're seeing shares trade off a little bit is because maybe guidance was not raised as much as people were expecting. So, they did say Parks going up 8%. I think maybe investors were looking for a little bit more. But overall, Lisa, really strong results, really kind of confirms the resilience in the business model and assuaged a lot of concerns, especially around, the competition from a new park in Florida from Epic Universe. We saw really strong growth, 22% increase in domestic park profits. So overall, really strong.
And yet the shares are lower, although after rising really quite significantly over the past 12 months. Bloomberg's Geetha Ranganathan, thank you so much. And we'll get an update with you as more earnings come out. Joining us now is Rich Greenfield of LightShed Partners. Rich, before we get into the nitty gritty, why are shares lower after what Geetha just described was a pretty blowout report?
I mean, I think you got to sort of step back. First of all, I think blowout might be a strong word. I think the reality is Disney stock has obviously had a nice little run over the course of the last 6 months. I think the company definitely, I don't want to say was sandbagging, but, if you listen to Hugh Johnson, Disney's CFO, he certainly was keeping He didn't raise expectations after last quarter's pretty meaningful, upside in the first, several quarters of the year. So I think there was sort of an expectation that this was going to be good, that they were going to exceed expectations and raise the guidance. And so I think it was sort of in the stock. So I think this has been a very widely owned stock. People were sort of knew that the outperformance was coming. And I think the reality is, I think the thing that surprises me is that there isn't more excitement around the WWE deal this morning or the NFL deal. But I think just sort of the, hitting what people have thought, and you're sort of seeing sell on the news more than anything else.
Well, the market initially really did like that deal when it comes to ESPN and the NFL media. What does this say to you about the direction of travel for Disney and the company writ large? Is that going to be a spinoff, Rich?
Well, I think that you got to step back. And so, the stock is trading, you've got it up on the screen right now, $115. If you go back 10 years ago, Disney reported their fiscal, Q3 earnings. The same week, 10 years ago, the stock was trading at this exact same level. So this has been sort of a lost decade for Disney in terms of the stock. Yes, it's been up and down in between, but 10 years it hasn't performed. I think it's really setting the stage for a strategic transformation. And, Iger's last year is 2026. And I think when you look at how they're positioning ESPN, if you think about sort of launching the direct-to-consumer service, having it stand on its own, adding in the NFL content, doing the big NBA deal, this morning doing the WWE WrestleMania deal, they are putting all of the pieces together to separate ESPN and probably ESPN and ABC from the rest of the Walt Disney Company at some point over the next 12 to 18 months. And I think that is going to be the next strategic catalyst for Disney. I don't know. I don't think they'll talk about it this morning, but it feels like they're setting the stage for that.
Does Bob Iger want that before he exits the company? And by the way, we should note expectations he's going to exit. Some think maybe he's going to stay on.
Look, I have no insight into whether Bob actually leaves. He certainly has been telling everyone that is close to him that he's really leaving this time. The chairman of the board, Gorman, is certainly tasked with finding a replacement. I think you're going to see that replacement. And, look, I think Disney has two core challenges. Figuring out the future. If you think about youth culture, my partner, Brandon Ross, has been writing about sort of the incredible surge of engagement around Roblox. Like, if you look at where youth culture is and where kids are spending their time, it's hard not to look at something like Roblox and go, how is Disney not in this world? Like, sure, they're building something on Fortnite, but if you look at sort of the UGC growth that's happening so organically on Roblox, like, that seems more like where Disney should be than trying to figure out the future of sports streaming with ESPN and ABC. And so I think sort of whoever is Disney's CEO, I think the big task is figuring out what is the future mix of this company? What is the ideal mix of assets to be positioned so that the next decade looks a lot better than the last decade?
There's also a question of the geographic footprint, Rich. I mean, we're seeing AMD shares fall because of a lack of certainty with China, but we understand that Disney has its footprints in China as well as around the world, even though some people might see it as sort of brand Americana. How much does that threaten, or how much do you want to hear about that on today's call?
And look, I think a topic that people don't really like to talk about, right, is how are U.S. movies performing overseas? And I think if you look at a lot of the international performance, you're seeing it be relatively underwhelming. And, I do scratch my head and wonder whether there is sort of a greater sort of anti-American sentiment. Certainly China has boxed almost, even if they let U.S. movies in, they don't do any box office anymore. And so I do think that there is this growing fear I have around Hollywood and the movie exhibition business, that international, which used to be sort of the huge upside for these films, like you did a good number in the U.S. and then you blew it out overseas. We're seeing a lot of underperformance overseas that is increasingly concerning.
Rich, I'm just wondering, looking forward, the other thing that we've heard in terms of a theme from companies has been artificial intelligence. And I know that Disney and other content creators have really not wanted to talk about this because of the strikes in Hollywood and some of the other concerns around what this will do to jobs. But is that going to be something that you expect to hear about, given that it's kind of a tool that they will need to be using?
I think everyone in Hollywood is going to initially look to how do they use this to speed up creation and reduce cost. The challenge is going to be not so much how a company like Disney or Warner Brothers Discovery or Paramount uses these tools, but how the kid in their basement, who never could have created a feature film before, now can. Like, will somebody come up with Bluey in their basement, right? Like, just using all of these powerful tools. If you're a good storyteller, you don't have to be a good animator anymore. AI can do that for you. And so I think what's going to be really interesting as you look forward is how the competition or the competitive landscape, not just for Disney, but for all these media companies, changes over the course of probably the next 3 to 5 years. I mean, the pace of AI innovation is astounding. And I think what you can do is only getting cheaper and faster and easier. And so the competitive dynamic that, that currently exists, there aren't many companies that do feature-length animation. I wonder in 5 years how we're going to think about the competitive set for animation.
Rich Greenfield of LightShed Partners, thank you so much for being with us today. And it's a really good point, and we'll have to check in with John, who's currently on an Icon of the Skis tour around Norway, and just about which Disney character is his favorite.
I highly doubt that. I'm sure he loves Disney movies, but I highly doubt he's on a Disney cruise.
In a serious note, this is a company that actually has performed really well, and you raised a great question about succession. How much can they put some sort of plan going forward of succession? And we've seen this at a number of financial companies. I am curious about what they say about that. We are seeing Uber also trading ahead of their call. They did report earnings. We also got earnings from McDonald's, all showing a lot of consumer demand. And I think that this really is the takeaway, even from Disney. People are paying more for their streaming subscriptions. They're paying more for their Icon of the Seas tours. They're paying more to go around the world to all of the theme parks. That takes money, and that takes capacity, and that takes confidence.
At the end of the day, the consumer is holding up. And this has been the big debate. Will the tariffs hit so hard, will prices have to adjust so much that consumers won't hold up? And they are holding up right now. When I go back to what Anastasia told us earlier, now we're entering the quarter where there's going to be a lot of choppiness. And the market's really going to have to digest the actual tariffs, not the uncertainty around the tariffs.
Yeah, market's open in about an hour and 4 minutes, and right now futures up. As they look ahead, we get Airbnb after the bell, and of course, jobless claims tomorrow. Coming up, Marc Giannoni of Barclays on risks to the U.S. economy. Right now, we're seeing a bit of a lift in equity futures ahead of the open. We are about 1 hour ahead. And right now, you can see a little bit of retracement from earlier highs, up about 0.1% on the S&P. Interesting that the Russell 2000 is erasing all of its gains, almost flat on the session after being up 0.4% earlier this morning. And the NASDAQ not doing much. 1 hour away from the cash open, as we mentioned. Here are your morning movers with Danny Berger. Danny.
Lisa, I do have the reason that tech is underperforming at least, and it's a lot of the pain in chip makers. Super micro earnings, those were poor, but also AMD. These were not poor earnings. They really showed up and were very optimistic on their sales and the future of AI. The issue for them, and the reason shares are down 5.6%, is because they couldn't give the certainty on when they'd be able to sell to China yet again. They said they wouldn't predict it, so again, those shares falling. On the other side of things, we also had Disney earnings. Those shares also falling 1.6%. Kind of the same story. Things like theme parks and streaming was good. They also announced that they are buying more of the NFL media network type assets. However, some of their linear street and normal TV channels not performing as well. That disappointment. Finally, wrapping things up with McDonald's. Those shares doing better. It was a sales beat. Some of the economic anxiety may be pushing people to cheaper options like McDonald's, up 4.3%. A lot of partnerships helping them too. Minecraft, but I'll spare us the Squishmallow conversation again, Lisa.
Thank you so much, Jenny, for reprising that conversation. Interesting with McDonald's how much they're gaining market share too. And that's something we will be looking at because we saw a different picture for Chipotle. So it's not all fast casual dining is seeing some sort of gain. It does seem like this is increasingly a winner-takes-all kind of market or stock-by-stock type of environment?
Execution. You've been totally right on McDonald's. Something that they've really been able to hone in on is how much money they're bringing from the international space, not just domestic in the United States.
Yeah, and so maybe some of those Happy Meals really gaining traction over in
Minecraft.
Europe. Yeah,
And
Minecraft. You're learning about what Roblox are this morning. Turning now to the Fed. A slew of Fed speak scheduled for today as investors await President Trump's pick for the Fed governor. Trump saying he will make a decision before the end of the week. Bloomberg's Michael McKee joining us now. Mike, we learned yesterday that one person, Scott Bessent, out of the race. 4 candidates that we understand. What's the process going to be like to get this person in that seat?
Well, the process is going to take a while because the person who goes to that seat is going to have to be confirmed by the Senate. And as we know, you've got to fill out a lot of paperwork, and then you've got to go through the hearing process. You make your rounds on Capitol Hill, shaking hands and making nice with senators. And if you get through the banking committee, then you go on to the Senate floor, which is pretty crowded with a lot of nominations these days. So nothing's a slam dunk at this point, which maybe means that for the moment, until we know who it's going to be, you should pay attention to what other Fed officials are saying about the possibility of a rate cut in September. We have several speaking this week, including Mary Daly today, and she is the one person that seems to have flipped her view, saying she's out of patience and she thinks maybe it's time to start cutting rates. We've also got Raphael Bostic tomorrow, and he has been the strongest perhaps in saying only one rate cut this year. Does he change his mind? Heading to the question, though, of who becomes the Fed chair. There are 3 candidates we know about at this point, the Kevins, as the president calls them, and Chris Waller, who's on the Fed board now, would not have to be nominated to the Fed board, but would have to be nominated to be chair. And then there's the mystery guest, because the president said there are 4 candidates, but he took Scott Bessent out of it. You can read all through the newspapers and wire services and stuff this morning and read a lot of different speculation on names. The question for the president, though, is how does he do this? And that's the biggest and most fascinating issue for me and for people on Wall Street. He could name his new chair in waiting to the Kugler seat, but then you end up with that shadow Fed chair issue. Who does the market listen to? Does it cause dissension on the Fed? He could name a replacement governor for Kugler, somebody who would just serve for a couple of months. But if Powell stays, it may be his only chance to name somebody to the seat. He could name a replacement now and choose a chair later, but then you get that apprentice scenario of maybe Warsh or Hassett and Bowman and Waller all auditioning for the job while they're trying to carry out monetary policy until the president makes a decision. So it's going to be very interesting. And
Mike, this is what I'm stuck on. How does he decide going forward? The president said yesterday we either decide on one for permanence or the 4-month period. What would be the point of having someone there for 4 months, given the fact that this takes a lot of time and it's challenging potentially at times when it comes to getting the Senate confirmation?
Yeah, and the other question on the other side of that, Annmarie, is that you have to ask who would want that job. You would have to divest all of your financial holdings. You would have to reveal all of your financial holdings and go through the confirmation process, which can be pretty brutal. And there's no guarantee that you're going to stay on. That would be a tough ask for anyone. Plus the fact, as we mentioned, it takes a long time to get through the Senate. Even if they rushed it through, probably not ready for the September meeting. And then there are only 2 more meetings this year. So you might serve for 2 months. I'm not sure that that's worth it to anybody.
Michael McKee, thank you so much, as always, for that update. Sticking with the Fed, Marc Giannoni of Barclays writing this: we retain our baseline expectation that the FOMC will deliver a single cut this year in December, but view risks as tilting toward earlier rate cuts with payroll employment having decelerated. Marc, that was at one point sort of consensus. Now it's a pretty rogue call considering what the market is pricing in for September. Why do you stick with that view?
Well, the employment has clearly slowed, and I think that's increasing the risks that the Fed will want to cut earlier than December. But at the same time, Chair Powell has emphasized last week that the unemployment rate remains fairly low, and that's a decent measure of slack for the economy. So when we think about the labor market overall, it hasn't really changed over the past year. What we've seen in the unemployment rate basically ticking up 10th in the last print, but back to the level it was in May, back to the level it was in July of 2024. The only thing that has really changed is the very significant but gradual slowdown in the pace of payroll employment. And as we've been writing for about a little over a year now, I think I talked about it on this show, I guess a year ago, that we have been anticipating a very gradual and extended slowdown in the pace of payroll. I think we are going to be looking at very slow payroll prints over the next few months, and this is because we have this very sharp reduction in immigration. We have a very significant slowdown in the pace of labor supply.
But we can't help talking about all the political intrigue and how that might have ramifications for Fed policy. We've talked about that with respect to the 2 dissents from Fed governors, the first time we've seen that level of dissent going back to 1993. We've talked about that with questions around who could replace Adriana Kugler over the next 4 months, as we were just talking about. Do you just block that all out, say, la, 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 let's look at the actual data and just hope for the best?
I mean, I think this is part of the reality, of course, and the FOMC is under tremendous amount of pressure. But at the same time, the FOMC has to do whatever they think is right. And I think what they told us very clearly and loudly last week was that they are not in a rush to cut rates at present. They are seeing downside risk to the labor market, especially if the pace of payroll slows further. If we see signs in, let's say, initial claims, for instance, jumping up, if we see the unemployment rate rising further, and we'll have another labor market print before the September meeting. But it could well be that the pace of payroll stays weak and the labor market remains tight. And I think this is our baseline as well. And I think in that context, with inflation likely picking up from here on a month-to-month basis and quite significantly over the next couple of prints, we'll have a Fed that is going to be facing a trade-off shock, basically facing a stagflationary shock, and they will need to make sure that policy is well placed for that. So yes, the political environment is a consideration, but I think they are very much focused on what's happening in the real economy.
Well, that's what the services ISM really pointed to yesterday. What did you make of that data? How challenging is that specific data point going into September?
Yeah, so I think what the ISM indicates is price pressures are here, right? And also on the services side, and they are coming. They are going to show up in the consumer prints. We expect like a 0.3% increase in the upcoming print. We expect like further acceleration from there, like a 0.4% in the following few months. We are likely going to see inflation, core inflation at about 3.5% by the end of this year. We have 3.4 on core PCE, 3.6 on core CPI. But bottom line, inflation is likely to pick up quite significantly from there. And I think ISM pointed that out, and especially on the services side as well. In terms of activity, I think what ISM says is, well, activity is slowing. And we see that. We expect the tariffs, which, yes, the tariffs have been in place since April, or at least a good part of them. Now they are going to increase starting tomorrow. But the effective tariff has not really increased very much in May and June. Because in effect, a lot of the trade that would have taken place took place in advance as businesses and households front-loaded a lot of the purchases. So we are going to really see the effect of these tariffs only in the upcoming months. And that should slow activity. ISM is telling us.
When it comes to what Lisa was talking about, and the fact that we're still waiting on these appointments, whether or not it's the BLS commissioner or who the president's going to put in the Kugler seat, will the market push back if it's someone overtly political?
I do think so. Yeah, I think the FOMC is going to push back if someone is overly political. I think when the monetary policy decision is made by the whole committee, each FOMC voter has one vote. The chair is one person and does not have authority that comes just with a title. The authority comes really from the credibility, the trust that other participants give them. So I think the market and the rest of the FOMC are going to push back against.
Just real quick, though, I mean, isn't this actually something that you've been struggling with, the integrity of the data? Not necessarily that it's political interference, but the quality of it, particularly in the labor market readings, has been going down, and this is something that a lot of people have been talking about.
Right, including people from the BLS have been complaining about resources, have been complaining about their because of the lack of resources, having to shrink the size of the surveys. That makes the survey naturally more noisy. The response rates have come down very significantly, and that's a challenge. That's a problem. The quality of the data has deteriorated because of that. I wouldn't call it integrity about the data, because I do think that the census and BLS and other statistical agencies have been doing a very professional job in terms of with the resources that they have.
You know, I have gotten a call, and I'd like to get a call. I'd like to give my response. Marc Giannoni of Barclays. Yesterday I got a call, and I thought maybe it was the call. It was the way to, like the census or something of that nature, but it was spam.
I don't pick up if I don't know the number.
Interesting.
So you have a better shot calling Lisa Abramowicz than my phone.
Which is probably the reason why response rates have gone down, because of all the Anmaries out there. Marc Giannoni of Barclays, again, thank you so much for being here. Right now, let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Swiss President Karin Keller-Sutter will meet with Secretary of State Marco Rubio on her emergency trip to lower the U.S.'s 39% tariff on Switzerland. The meeting is scheduled this morning in Washington, but the Secretary of State's department does not lead negotiations for bilateral deals, and it remains unclear if she will get to meet with President Trump. Meanwhile, Bank of America is asking its junior bankers to disclose if they've accepted jobs elsewhere. Sources telling us here at Bloomberg, individuals who accept offers will likely be moved to another area within the bank. Citi and Goldman Sachs have made similar moves to discourage employees from pursuing new jobs. And how's this for some nostalgia? Claire's, the accessory store for preteens, has filed for its second Chapter 11 bankruptcy. The once beloved mall staple is facing higher import costs for its goods and a rocky consumer spending outlook. Claire's currently has 2,750 stores across 17 countries, down from over 4,500 stores at the time of its first bankruptcy back in 2018. That's your Bloomberg Brief. Lisa.
Thank you so much, Yahira. Where will the tweens shop? Up next, setting you up for the day ahead. Plus, Winnie, Cisar of CreditSights, moving up her expectations for the Fed's next cut. That's coming up next. This is Bloomberg.
The hard data, by virtue of the fact that it's hard, is rear view mirror stuff. It's what the Fed uses, as an example. I call it the cracked rear view mirror. Trying to make forecasts based on hard data is you're fighting yesterday's war. So the Fed is now coming around because the hard data is finally softening up. We've been screaming that they should be cutting way back in the spring. They're now going to do that. We're entering a cutting cycle. But the soft data is starting to turn.
And it's starting to turn up. That was Stephen Auth of Federated Hermes, who's talking about his optimism going forward as we look at equities, trying to start the day in the green. We have seen them claw back from some of the earlier gains, but still up 0.2% on the S&P. Yields retracing some of the earlier rise that we saw earlier, now just up a basis points, 4.22% on that 10-year yield. We are getting some news on Apple. The White House revealing that Apple is planning to boost its U.S. investment commitment by $100 billion. Those shares, futures popping in the pre-market, 1.6% gain. Annmarie, this looks like this might be the 4:30 p.m. meeting at the White House.
Yeah, it does sound like it, because this is going to be happening, according to the White House, this new U.S. manufacturing plan, this announcement that Trump is going to make about Apple. And then Kevin Hassett was also speaking to the press earlier and said he's likely to hear about this new factory from Apple today. So it looks like Apple is going to, I guess, outline their plans for more manufacturing, more dollars into the United States. What I find so interesting about this is the personnel, because Tim Cook did a very good job with Trump in 1.0 to be able to really maneuver his way about what he needed from the U.S. government when it comes to carve-outs, et cetera. That person has really been Jensen Huang of NVIDIA this time around, so maybe he's trying to cozy up a little bit more to the White House.
Or reprise his role as ambassador-in-chief to the tech sector. We're going to be following that throughout the day. Meanwhile, counting you down to the opening bell, here's your trading diary for the rest of the week. 1 p.m. Eastern, don't miss this. The Treasury auctioning $42 billion in 10-year notes. 4:30 p.m. We will get that announcement. We are expecting it to have to do with Apple's investment to the United States. We'll also get Fed speak from Daly, Cook, and Collins Thursday. A rate decision from the Bank of England and another round of jobless claims. Plus, President Trump's new global tariffs will take effect. We'll also be hearing about any additional tariff discussions that we've been talking about throughout the morning. And next Tuesday, really a key data point, the CPI data, especially after yesterday's ISM services indicators, kind of pointing to a bit of an inflationary boost at the same time of stagnating activity. Turning back to the Fed, Winnie, Cisar of CreditSights, pulling forward rate cut expectations for the year, writing, with the July payrolls report, we capitulated on our Fed on hold call for 2025. Winnie joins us now. Winnie, thank you so much for being with us. Let's just talk about what made you capitulate. Was it political? Was it the data? And how much do you see the Fed being able to cut?
Sure, Lisa. Good morning. Thanks for having me on. It was the data. In our Fed preview earlier in the week last week, we had noted if we saw multiple months of sub 100K job ads and a continued erosion in labor force participation, that we would expect the Fed to get a little bit more concerned around the labor aspect of its tool mandate. And with the July payrolls report, we basically saw all of those milestones achieved, and of course, a not very great way. And when we look back at last September, when the Fed came out with its jumbo rate cut, we're seeing a lot of parallels in terms of the economic data, and that did cause us to pull forward some rate cutting expectations we had initially envisioned for 2026, now into 2025.
One thing that's unique about your research, Winnie, is that you're talking about where the Fed's going to set rates at the same time that you're scouring all of the corporate earnings reports for the credit universe that you oversee. How much is there a dissonance between the strength that we keep talking about in the earnings and the weakness that we keep talking about will prompt the Fed to cut rates?
Yeah, there definitely is some cognitive dissonance going on in so many ways, both in corporate earnings versus the macroeconomic data, the hard data versus the soft data. And I think that a lot of people are a little bit too focused on what has happened already. We know that corporate credit fundamentals have been in good shape because we haven't seen an intense releveraging cycle as the Fed hiked rates, as we had a lot of uncertainty. And people are really kind of hanging on their hats on those credit fundamentals remaining intact. But at the same time, we know objectively that the consumer is in a worse spot than it was at the beginning of 2022 or 2023, and that there are a number of new factors and new policy considerations that corporates are going to have to maneuver. And at the same time, we have a lot of technological developments, which we're seeing have some impact on the labor market as well. So I think it's a bit of a mistake to think, okay, Q2 earnings came in much better than anticipated. Ergo, Q3, Q4, next year will all be fine as well.
Winnie, I know you're pulling forward your rate cut expectations. What happens at the end of the year when potentially, we were just hearing from our last guest, the fact Marc was talking about we could have 3.5% inflation at the end of the year. The ISM services basically signaling a stagflationary environment.
Yeah, it does make us nervous. And a stagflation light type scenario was our base case coming into this year. It feels like it's taking a little bit more time to play out than we had initially anticipated. Now, by the Fed's own summary of economic projections, they see room to cut rates, even if we see core PCE inflation rising a bit through year end, so long as the unemployment rate is also rising. It's a little bit trickier to get to an increased unemployment rate because of that participation dynamic. But that does, I think, leave risk assets in a little bit of a vulnerable situation if we don't have as much room for the Fed to be proactively easing. And we have these inflationary impacts and also a weakening job market. It all kind of sounds like you're setting up for some risk off and, importantly, wider spreads in credit where fundamentals finally matter again.
Why can't the Fed rate cut save the corporate sphere, given the fact that there's not that much weakness and a lot of companies have a lot of positivity? The Fed cuts a couple times, and that actually gives a pretty upbeat look to some of these otherwise neutral forward forecasts.
Yeah, Lisa, it's a good point. And we do see a path for proactive rate cuts that result in a continued bid for risk, a continued grind tighter in corporate credit. But that's really predicated on this immaculate disinflation materializing. And so far, it seems like from the soft data that immaculate disinflation is not necessarily going to be the outcome, at least in the near term, with some of the pricing pressure reemerging in services, seeing some pricing pressure in goods again as well. So it's a lot more difficult to get to that point where the Fed can kind of gradually and proactively ease rather than having to react to weakness in the labor market while also managing some reinflationary pressures within the system.
Winnie, Cisar of CreditSights, thank you so much for being with us. Right now, we are looking at a market that is a bit risk on, although that could change. We saw that yesterday. It's been 5 of 6 days that have been down over the past week or so. I am curious about this Apple announcement. We mentioned it earlier, and Anne-Marie, it looks like President Trump is going to announce alongside Apple some sort of commitment to increase production here in the United States.
Yeah, a new $100 billion commitment. It comes at an interesting time, too, because remember, Apple has been trying to move a lot of their manufacturing out of China into India. At a time now, Trump 2.0, there has been some serious tension between New Delhi and Washington. And I wonder if Tim Cook is going to be once again caught in the crosshairs of what is going on in the tariff story. But right now, they seem to be showing good favor with the president, saying they're going to have this commitment to build some sort of manufacturing plant factory in the United States.
So maybe the memes of people wearing Patagonia vests and building iPhones will come to fruition. We also are tracking earnings. Airbnb expected after the bell. We did already get Disney as well as Uber and McDonald's. A positive look, and yet what we have seen consistently is markets have already priced everything in, and that really has been the theme.
Markets already priced in a lot of the uncertainty. What is going to be so interesting for the rest of the year, I think, is that we're actually going to see the tariff rates hit. And what do companies do with that?
And that's what we're going to be speaking about tomorrow with Kate Moore of Citi Wealth, who has been a little bit cautious on that. Jim Bianco of Bianco Research, former NEC Deputy Director Everett Eisenstadt, and Kelsey Barrow of JP Morgan Asset Management. Have a great day. This was Bloomberg Surveillance.